The Fed is going to take its cue from the path of trade policy.
Inflation is the element that they're concerned about.
We know that they are baking in some weakening in the labor market.
They're definitely going to be on hold and evaluating.
In the near term, it makes sense for them to be on hold.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance. It ought to be Fed Wednesday. That is what we would say normally, with the U.S. Central Bank delivering a rate decision forecast. Or normally we'd point to jobless claims and housing starts due out later this morning, with weakening trends taking hold across a number of economic indicators. But all of that is second fiddle today as the war between Israel and Iran enters its sixth day with an increasing focus on the U.S.'s role in the conflict. Will the U.S. get more actively involved, Annmarie? And that is really the question after yesterday's meetings with President Trump.
Well, President Trump is giving Iran an ultimatum right now, and he's basically signaling you have to make this decision to give up nuclear weapons or the progress potential path to this enrichment to make a nuclear bomb, or we will make that decision for you. And he's doing that by fortifying the military, sending the U.S. aircraft carrier into the region, sending a number of jets that can help with refueling. So he's messaging we are prepared and could do this. The White House and the president certainly understands the consequences, though, of intervention. So I don't think it's a decision he will make lightly. He did meet with his national security team yesterday. He had a call with President Netanyahu. And at the moment, the world is just waiting with bated breath, basically, to see what the United States decides to do.
The world and, frankly, markets, which can't really price in the uncertainty that just keeps coming in waves of new data points and new narratives that we get every single day. It raises the question for the Federal Reserve as you face off with this question of how do you price in inflation from tariffs? How do you price in inflation from potentially some sort of disruption in the Middle East? And how do you understand the slowing growth that we have seen with recent economic surprises coming in negative?
I was just speaking to Andrew Hollenhorst in the pantry, and he was on about a half hour ago. And what he said to me was basically, if the Fed right now didn't have all this uncertainty in terms of tariffs, but they were looking at the hard data, would they not be having this meeting and say, now is the time to cut? We've had consecutive reports that inflation is coming down. Why would now not be the time to cut? It's because they have this overhang, this cloud of this uncertainty when it comes to the tariff rates and what that might do to inflation and potentially an inflation spike spiral.
People are already sensing that maybe they will be cutting rates at least once or maybe even twice later this year. Right now, when you take a look at markets, you could see this quiet feel across the board, a little bit of a rally trying to regain some of what we lost yesterday, up almost 1/3% for S&P futures. Yields lower, and they've been lower for a number of consecutive days. 10-year yields 4.38%. You could see a similar type of move in the 2-year space. And oil prices, this is important, down almost more than 0.5% as people game out exactly what the U.S. involvement will be in the Middle East. Coming up this hour, Julian Emanuel of Evercore ISI as stocks tick higher ahead of that Fed's rate decision. George Saravelos of Deutsche Bank as the dollar snaps a 3-day winning streak. And IAEA Director General Rafael Grossi as Israel attacks nuclear sites. We begin this hour with our top story, Israel and Iran entering a 6th day of conflict. The White House weighing direct involvement. Joining us now from the Middle East is Bloomberg's Jumana Bersachi. Jumana, what's the latest?
Yeah, well, just as Annmarie was saying, the whole world is waiting to see what the U.S. decision is on whether to get involved militarily. Remember, President Trump departed G7 summit rather abruptly yesterday, ostensibly to focus on the situation in the Middle East. And this time, yesterday, he spoke about looking for something bigger than a ceasefire, which sort of opened up a sliver of hope that perhaps he was thinking about the diplomatic channel and perhaps re-engaging with Iran and bringing them back to the table for this nuclear deal. However, the stance has taken a lot more of a hawkish direction in the last 12 hours or so. If you look at the post that he's put up overnight, he's talked about demanding Iran to surrender unconditionally. He's talked about we having control of the skies and using the plural, suggesting that the U.S. are somehow involved already in the attacks that are taking place. And then has talked about knowing the whereabouts of the Ayatollah and sparing them this time around, i.e. suggesting that the U.S. could target the Ayatollah should they choose to do so. And so at this point, the U.S. president has to make a decision about whether or not they do want to get involved militarily. His advisors seem to be divided on this issue. He did have a meeting yesterday with his national security cabinet. There was no readout of that meeting, I should say. He also had a phone call with the Israeli prime minister. Again, we don't know what went on in that call, but what we do know is that the whole world is waiting to see what the U.S. decides, because it does run the risk of turning this into a more regional conflict, especially because the Iranian side are saying that they're watching very closely, they're monitoring the U.S. involvement, and they would not hesitate to react in a proportionate manner should they see that the U.S. are getting militarily involved as well.
Jumana, a lot of people keep talking about regime change, but this isn't Lebanese Hezbollah or Hamas. This is a government with thousands of people in it. When people say to you regime change, what does that look like?
I think at this point, a lot of that comes down to wishful thinking. Remember, this is a country of more than 90 million citizens. And as you mentioned, those senior commanders, IRGC, have a stronghold over the population. They have not allowed for any opposition, any dissent in the last couple of decades. So it's unclear at this point who necessarily would take over should there be a change of leadership. And then there's also the parallels of history. You don't have to go that far. President Macron talked about it yesterday on the sidelines of the G7 summit. He said, we all remember what happened in Iraq after 2003. We remember what happened in Libya. Even today, you're still feeling the effects of military intervention in Libya with all various tribes and factions fighting amongst themselves, no clear leadership on the back of that. And so there are parallels to be drawn from history of what happens when there is forceful intervention and an attempt to remove leadership without a viable replacement and without viable institutions in place. So there's a real fear in the region that the military objectives are not just military objectives, but the ultimate goal may be actually regime change. But at this point, it's unclear what that may lead to. And there is a real fear that it could actually bring about more chaos in the region as opposed to more stability.
Bloomberg's Jumana Bersachi, thank you so much for the update. Right now, let's get the view from Wall Street this morning. Julian Emanuel of Evercore ISI writing, with this backdrop, no surprise by the Fed. It could be the biggest surprise of all, depending on how the news on everything else breaks. The one thing we do know is that the call to lower interest rates will ring loudly once again. Julian joins us now. And before we get to Fed, the other story in the room today, we have to get to what we've just been talking about, which is how much what's going on between Iran and Israel does have ramifications for markets.
There's no question it does. And I mean, look, we're looking at our Bloomberg monitors, all three of us here, waiting and understanding that Khamenei is about to make a speech that who knows what that path is going to look like. But as investors, this is one of these times where you have to understand what you're trying to achieve in your portfolio and try and filter out the noise, as difficult as it is, given the fact that when you look at this year, markets have gone through the entire range of emotions. You know, it started very exuberant, then outright panic, and then when we figured out that there wasn't going to be a recession, you know, really exuberance once again. And now it's time for patience.
But this potentially is a seismic shift in the region, not just noise. What do you do with that?
You stick to your knitting, and if you're an active manager, you have to think about ways to stay invested but hedge, okay? And look, the fact is there are so many different paths that this could go down, and obviously one of them could be an ultimate de-escalation. Obviously, no one has said anything about regime change. You know, I'm hearkening back to when I was a young man, seeing what happened in 1979. Who knows if that's the ultimate outcome? But again, just going back to the fact that as an investor, you have to think, first off, that there's likely to be a larger premium in the oil markets than there was 6 weeks ago, when, you know, frankly, it seemed a little weird that the price was as low as it was, given the fact that we're not in a recession.
So let's take a step back. If it weren't for what's going on between Iran and Israel, we'd be talking about the economic data. We have seen the U.S. Economic Surprise Index, at least by Bloomberg, roll over to the most negative that we've seen it so far this year. We have seen a series of economic data points that have shown this weakening trend. Is there increasing pressure on the Federal Reserve right now to signal some sort of dovish bias, this idea that all things being equal, putting these disruptions aside, there is something that's happening here that they should be responding to.
Well, look, and again, you look at the weekly jobless claims, they're the highest they've been in a number of months. But by absolute standards, they're still very, very low. And we're talking about an unemployment rate, again, in the low fours. And this is one of these times where the Fed is going to remind us all that the dual mandate really is a dual mandate, and that most people, Evercore ISI included, believe that inflation is going to tick higher. You're going to have a 3 handle later in the year.
So talk to us about the bull market call that you've had and what it sort of is predicated on. Is it the idea that inflation will be somewhat sticky, but growth will also be better than it certainly is showing right now? Is it this idea that all of these other issues that we're talking about are going to get resolved? I mean, what's the base case in terms of how much this market can look through? Because right now, the resilience has just rather been shocking to a lot of people.
Well, no question about it. And I think, and this is part of the issue to us, we've had several months now, and obviously the last batch of inflation data was much more positive than people expected. We're not entirely certain that if, in fact, the data does deteriorate as we and others expect, that the market won't get a little bit perturbed by that, because you've had these months of sort of being lulled into a belief that maybe it won't happen. From our point of view, this is one of these secular times where the technology's advances are going to ultimately bleed into a greater level of productivity. It's no coincidence that we're seeing companies across a slew of industries talk about AI implementation actually being able to drive revenue. That was the thing we were all wondering about last year. It's starting to crystallize. And in that environment where their liquidity is still ample, you can support higher stock prices, plus the earnings trajectory remains rather solid.
What's your North Star as we look at all of the potential competing narratives right now?
For us, it continues to be this idea that the elements that end bull markets are not in place. Recession, the Fed is not going to hike whatever the inflation number is. We think that consistent with every bull market, you're going to have a period of greater speculation and greater capital markets activity, and that's still ahead of us.
Julian Emanuel of Evercore ISI will be sticking with us for the hour. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. We start with the latest out of the Middle East. Iran and Israel exchanged fire for a 6th day. The IDF said it identified missiles launched from Iran and intercepted most of them, while Israel said it hit a facility that made centrifuges for uranium enrichment. The New York Times reported that Iran was preparing missiles for retaliatory strikes on U.S. military interests in the Middle East if President Trump decides on an offensive campaign. Meanwhile, the Supreme Court is being asked to weigh in on President Trump's economic agenda. 2 family-owned toy companies are asking the High Court to consider striking down many of the president's tariffs. They argue that the massive impact on businesses and consumers requires immediate intervention rather than waiting for a federal appeals court to rule. And Amazon CEO Andy Jassy says he expects the company's workforce to decline in the next few years as it uses artificial intelligence to handle more tasks. In an email to staff, Jassy says the technology will mean fewer people in some of today's roles and more people doing other types of jobs. Jassy says he expects that will lead to efficiency gains across the company. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. We'll be talking more about that coming up, something people have been speculating about for quite a bit. Up next, we're going to be speaking about increasing pressure on Iran.
Up to this point, the policy of President Trump, and candidly every president before him since Iran has had a nuclear program, is that Iran will not have a weaponized nuclear program.
Joining us next, former White House fellow Elliot Ackerman with more about what exactly is going on with assets building in the Middle East. This is Bloomberg Surveillance. This is a market that likes to shrug off any potential risk, and that seems to be what it is doing this morning. After declining yesterday, we are seeing a bit of a rebound, up about 0.25% on the S&P. You're also seeing a bit of dollar weakness as people take a look at just what this means going forward. 115, we've been hovering around that level for euro dollar for a while, and yields lower across the board, 2.10s and 30s, with 10-year yields at 4.38%. Under surveillance this morning, increasing pressure on Iran.
Up to this point, the policy of President Trump, and candidly every president before him since Iran has had a nuclear program, is that Iran will not have a weaponized nuclear program. This world needs less nuclear-armed countries rather than more. And if Iran, Saudi Arabia, the UAE, Turkey have nuclear weapons, that's a level of instability that I don't think we want to undertake.
Here's the latest. The war between Israel and Iran continuing for a 6th day. President Trump weighing his options in the escalating conflict. Trump calling for Iran's, quote, unconditional surrender before his meeting with his national security team. Bloomberg's Akayla Gardner joins us now. Akayla, can you give us a sense of what the consensus is right now in Washington, D.C. about what the U.S.'s role should be?
Well, yesterday, President Trump met with his national security team for more than an hour, but he's been pretty quiet since that meeting, so we still don't know exactly what path the U.S. is going to take, but we have seen his rhetoric sharply increase in the last 24 hours. He has gone from talking about a diplomatic solution with Iran to negotiate over their nuclear program to now really using assertive, aggressive terms. He talked about an unconditional ceasefire. He also mentioned knowing the location of Iran's supreme leader and saying that there's complete control over Iran's skies. And you saw Vice President Vance yesterday very explicitly leaving the door open to the U.S. getting involved in some of the attacks that we've seen Israel already doing on nuclear facilities. And yet, at the same time in Congress, there's really concern about the U.S. getting into a longer-term war here for years, as we've seen in the past, the U.S. getting drawn into these conflicts. So Congress is really seeking to limit the president's powers here using the War Powers Resolution, and yet to see what President Trump's response is to that specific resolution.
Bloomberg's Akayla Gardner, thank you so much. We'll be catching up with you in just a bit. Joining us now is former White House fellow Elliot Ackerman. Elliot, thank you so much for being with us. Really looking forward to hearing your insights. First, what do you think is happening? And what do you think the U.S. is waiting for as they deliberate over what their actions should be with Iran?
Well, I imagine, at this point, there's significant coordination with our Israeli allies as they degrade Iranian capabilities. And I imagine there's a lot of back channeling amongst our allies that we would be going through before launching any type of decisive strike against Iran's nuclear facilities. So, that's assuming the decision has been made. I'm also not confident that the decision hasn't made yet. President Trump might be waiting for conditions on the ground to continue to develop.
I'm also not confident a decision hasn't been made. It feels like he's trying to give Iran an ultimatum. Could you see potentially him just trying to use this and get Iran back to the negotiating table?
Yeah, it would certainly align with how President Trump has behaved in the past and the tactics that he uses, including, unconditional surrender, which is obviously a somewhat vague term, and threats against Khamenei. So I think we sort of have to watch and see how this will play out. But I think, unlike U.S. military involvement in the past, and for instance, Afghanistan or in Iraq, the type of military intervention that's being discussed is, much more limited, much more precise, particularly in what its objectives would be.
Elliot, then how does the United States prepare for the retaliation that they could expect from Iran?
The main retaliation that's being discussed and that would be within Iranian capabilities is a strike on U.S. assets abroad, specifically military assets. And we've seen this in the past. And, other times when Iran has launched these type of retaliatory strikes, candidly, they haven't been particularly effective. So we'd have to see, the U.S. is deploying assets into the region that not only could be used to strike against the Iranians, but could also be used to provide a greater measure of force protection to those assets. But that's really the main Iranian capability that we would see used against the United States.
When you look at the posture that's changed now in the region over the course of the last 48, 72 hours, do you think the U.S. is in a place that is actually prepared if it was to go for that strike offensively as well as preparing defensively for the retaliation?
We have the potential to get these assets in place pretty quickly. And obviously sort of the main offensive action that's being discussed would be a U.S. strike against the Fordo nuclear capability, which is that Iranian nuclear facility that's buried deep underground that the Israelis don't have the capability to destroy. And so those assets have been moved into the region. And, I think it's really giving President Trump the options, should he use them to launch that type of a strike.
Elliot, curious to know what you think Israel's role becomes if, in fact, this is a maneuver to get Iran back to the negotiating table.
I think, listen, when we're looking at this conflict, this is a war between Israel and Iran. And, discussed U.S. participation is really, at this point, to give Israel the capability to just launch more intense strikes. And then ultimately, these wars sort of end in one of two ways. One would be the Iranians coming to the negotiating table, and the others would be a potential collapse of the Iranian regime. So, those are both potentialities. And at the end of the day, I think Israel will be leading whatever the end of hostilities look like, with the U.S. in more of a supporting role.
Do you think that there is a scenario, Elliot, where the U.S. and Israel could take out all of Iran's nuclear capabilities without some sort of massive regime change at the top?
It's tough to say with these things because it's very difficult to get a good handle on internal politics in a country like Iran. I mean, so often when these regimes collapse, it surprises so many of us. And conversely, there's so many regimes that seem to hold on despite all of the odds. But listen, everyone is certainly putting their cards on the table. What we've seen with Israel's war, not only this war in Iran, but also in Lebanon, is that many of these regimes and their proxies are far weaker than we have supposed. And I think this is putting massive strain on the Iranian regime in a way I haven't seen in decades, if ever.
Elliot, though, isn't also the concern that they could just be replaced by individuals around them who are even more to the right of where they stand?
And listen, that is always the concern. I mean, that's why they call it the iron dice of war. That when you go to war, you're taking a big chance. And I think the chance is, yes, you could have more extreme elements. You're creating a vacuum and you don't necessarily know what steps into that vacuum. So, President Trump, Israel, are all stepping into a massive realm of uncertainty.
Elliot Ackerman, former White House fellow, thank you so much for being with us as we try to figure out what exactly the next steps could be. I'm struck by, Annmarie, the fact that we really don't have a sense of what exactly could happen. And right now, people are just assuming, look, if something happens, it's not going to disrupt everything that much so that it would actually disrupt what's going on currently in the U.S. economy.
Right. Of course, although if Iran does decide to do something they've threatened for years but never actually took the step to do, which is to close the Strait of Hormuz or make it very challenging for tankers to go through the Strait, where a fifth of global oil supplies and some also LNG supplies go through. What I find so interesting about the conversation is when you speak to Israelis, they leave that door open, that possibility, that hope that there could be regime change. When you hear from the President of the United States, he has made it very clear for years that he wasn't really going after regime change. He says Iran cannot have a nuclear weapon. So I think when you think about why the United States would want to get involved, it's to go after these places where Israel just doesn't have the capability, but where they are concerned that Iran has that uranium enrichment.
Julian, how much are you watching this to try to get a sense of how it will have ramifications potentially for the U.S. outlook?
You're watching it incredibly carefully. And I mean, as that conversation was occurring, we saw the futures markets ticking down. And I'm thinking to myself, are there headlines that we haven't just seen yet? It really is one of those things that, again, against the backdrop of a market that's expensive, it is a major, major consideration.
Well, coming up later this hour, we're going to be speaking with the IAEA Director General, Rafael Grossi. Do not miss that as we try to understand what the ramifications are for the Iranian nuclear program. This is Bloomberg Surveillance. If there were a phrase for markets in 2025, perhaps it would be uncomfortably numb, at least right now, because what we're seeing is a real level of calm in markets, even with a whole slew of very dramatic headlines. Despite what we're hearing about a sixth day of conflict, of war between Iran and Israel, we are seeing futures up just slightly, hovering very close to those all-time highs, up about 0.1% on the S&P, and the NASDAQ up about 0.25%, 3 hours away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, you have a lot of stocks this morning and indeed yesterday moving off the back of what we got out of Washington, D.C. Circle, it is a stablecoin issuer, up nearly 3% in the pre-market trade. That's because the Senate has passed legislation that is around stablecoins. The hope is it becomes more mainstream. Basically says that for stablecoin issuers, they need to hold dollar-for-dollar assets of short-term government debt. So that excitement there for this stablecoin issuer, up 2.7%. That bill now goes to the House. Now, yesterday, it was the big, beautiful bill that captured the attention of some of the stocks like Tesla yesterday. The fact that you had a quicker phase out of some of the clean energy tax incentives, that meant that Tesla fell nearly 4%. It is rebounding this morning, but I got to say that rebound is starting to ebb. It was up nearly 1% at one point in the pre-market, now just up by 0.6%. Same goes for Peloton. In the legislation, in the House version, there had been legislation that said if you have an HSA account, you can use it on spending on fitness things like Peloton. However, when the Senate released the bill, that was gone. So we saw Peloton sink double digits yesterday. But again, we are buying the dip this morning. Those shares up 2.2%, Lisa.
Thank you so much, Danny. Meanwhile, on our radar this morning, as we've been talking about throughout the morning, the Israel-Iran war entering its sixth day of conflict after President Trump met with his national security team, fueling speculation that the U.S. is on the verge of joining the attacks. And Annmarie, one thing we haven't talked about is just the conflict within the Republican Party about whether or not the U.S. should be more involved.
Right. There are many on the far right, the MAGA base, the likes of Tucker Carlson, even going after Senator Cruz in his most recent podcast about why the United States would want to get involved. President Trump has said he does not want any foreign wars. He wants to untangle America from global conflicts. Why would you want to intervene? But the president also has been very clear for years that Iran cannot have a nuclear weapon. There's something happening today that I think everyone should really be paying close attention to. The president will be sitting down with Pakistan's army chief. This could potentially be someone that could be an interlocutor that potentially when the president says there's an ultimatum, where either you make that decision or we're going to make it for you. I think what comes out of this meeting could be very telling on where the president's thinking is right now.
Yeah, who wants to be the mediator? It seems like everyone's kind of raising their hands. Meanwhile, this story would be getting a lot more attention if it weren't for what's going on in the Middle East. U.S. bank regulators planning to lower capital requirements for the country's biggest lenders. Sources telling us here at Bloomberg they plan to cut the enhanced supplementary leverage ratio and will apply to banks like J.P. Morgan, Goldman, and Morgan Stanley. Julian Emanuel is nodding his head along. And I have to say, this was possibly the reason why we saw a real rally into the long end of the Treasury curve yesterday, as people speculate that maybe this would open the door to banks owning more Treasuries.
Well, I go back to March and April when we were getting questions multiple times a day from clients saying, does the Trump administration actually not mind a recession in order to keep long end bond yields suppressed? And we thought that was ridiculous, and the market figured out it was ridiculous in April. But the fact is that they understand very, very well, and they're going to understand it even more when the big, beautiful bill gets passed and the deficit continues expanding, that they're going to need to do everything they can to keep yields under control, and this is a big step.
Yeah, at this point, though, it's unclear why big banks would want to own more long-term treasuries at a time when so many companies have come out and said, actually, long-term treasuries are a risk asset.
Look, the liquidity provision function, however it evolves, is very central to this narrative of the United States remaining the premier destination for capital, and this is going to help at the margin.
Meanwhile, what might not help at the margin is a question around whether we have jobs. Amazon CEO Andy Jassy expecting a workforce decline in the next few years as it uses AI to handle more tasks. In an email to employees, Jassy saying they need fewer people doing jobs that are being done today and more people doing other types of jobs. Annmarie, I know you've been really big on this story. We all have. It's a real question of how much artificial intelligence is going to transform our workforce.
Absolutely, and it feels existential almost if you're reading this, I imagine, especially if you're sitting behind that email at Amazon. what is that job that other people are not doing right now? I think that's the big question that lingers and people are concerned about. But remember 3 weeks ago, Anthropic came out and talked about how basically when you have white collar jobs, those entry level jobs are going to be absolutely decimated. This is going to really impact politics. Actually, Steve Bannon in his War Room podcast has been talking about this. No politicians are paying attention to this. If people start losing their jobs and it's because of AI, people are going to start to say to politicians, where were you? Where were you trying to protect where we were? And I think you're going to see more emails like this from Amazon. It's going to become a much bigger political issue.
When you say where were you, the politicians might say, we've been focusing on the one big beautiful bill. We've been focusing on what's going on in the Middle East. When you take a look at what's going on in Washington, D.C. and that big beautiful bill, the Congressional Budget Office saying the House-passed version would add $2.8 trillion to the deficit over the next decade. This as the bill moves through the Senate. Vice President J.D. Vance pushing the chamber to pass it by the July 4th deadline. Joining us now is Wendy Schiller of Brown University. Also in another world, we would be focused on this in terms of what the ramifications were for the deficit, for debt rates in the United States. How much do you see this as actually getting passed by July 4th, given the dissonance that we're seeing truly between the House and the Senate?
Well, I think that the House was a little surprised by the content of the Senate bill. I think they thought it was the cuts to Medicaid are even starker. I was surprised about that. We've had a couple of senators come out and say they didn't even like the cuts in the House bill. And then the Senate Finance Committee comes up with something even starker and more dramatic. So I think there's internal division in the Senate Republican caucus. We've seen that they came out of a meeting the other day and it wasn't all smiles and, oh, yeah, we're all on board. Thune is under tremendous pressure to get it done, but he's got to get it through his own Senate. And right now there isn't enough support for the version that came out of the Finance Committee in the Senate, which means the July 4th deadline just seems, unless a miracle comes, somewhat unrealistic. I think they can all say, well, the world's sort of got conflict now. We've got this question about whether we go into Iran. So maybe we have to put it, take a little longer. And also the reports about what it will do in terms of raising the debt ceiling and the deficit itself. I think these are larger issues that the Senate will have to grapple with before it can get a bill back to the House. So is July 4th, Wendy, off the table? They never say it's off the table, right? Party leaders, they never want to admit, quote unquote defeat. But I think they have an excellent, if you will, excuse right now to say that they have to focus on multiple things, particularly whether the president wants to take military action. Does Congress have to give the permission to use military force? It depends what kind of military force the president uses. So I think they have a chance to say, oh, well, we'll push it to August. They all want to get out of there usually, Annmarie, you know this better than I do, by the beginning of August to go home, and they want a victory when they go home. So I think unless they can pull it out in the next couple of days in the Senate, I'm just not sure how they get there on July 4th.
Wendy Schiller of Brown University, thank you so much for that insight. There is this question about how much an increase in the deficit will undermine American exceptionalism. George Saravelos of Deutsche Bank has been writing about this quite significantly. George joins us now. Thank you so much for being here. I want to start there. How much is what's going on in Washington, D.C. with the one big beautiful bill affecting markets and bond markets in particular, as well as the dollar, more than what we're hearing in terms of the conflict in the Middle East?
So I think it's very relevant. And from a currency perspective, a global perspective, the key point to make is that it's not only the fiscal deficit, but the external deficit. And if you look historically, budget deficits are a problem when a country relies on foreign inflows. And that's the source of the so-called twin deficit phrase. And I think that's the key source of the vulnerability. Now, of course, within that context, if you have weaker growth outcomes, higher inflation, your deficits become more problematic because the rest of the world is unwilling to fund them. So it is context dependent. It also depends on what's going on with tariff policy, the Middle East. But absolutely, I think the US twin deficit problem is not going to go away on the back of this big, beautiful bill, which essentially extends the problem through the rest of the decade.
George, we paid a lot of attention to the fact that the dollar didn't really get that much of a bid during some of the tumult that we saw on Friday and even earlier this week. We also saw that there wasn't a bid into long-term bonds, again, typically a haven asset. A lot of people have come on this show and pushed back and said this isn't really a loss of U.S. exceptionalism. This isn't anything really to write home about other than the potential threat is inflationary. You disagree. Why do you disagree?
So I think with respect to the Middle East market reaction, I would point to the price of oil. And while you did have a big spike in the price of oil over the last few weeks. Bear in mind, if you look at the entirety of that oil curve, it hasn't moved that much. The market is pricing a temporary disruption to the oil market. But then if you look further ahead to what that curve is doing, it's telling you there's likely going to be an OPEC response, or even if Iranian exports are disrupted, they'll come back. So personally, I wouldn't center this discussion of the lack of reaction either in treasuries or in the dollar on the back of the safe haven discussion, but more about the market not really believing there's going to be a genuine disruption to energy markets. And you can see that very clearly in the oil price and the shape of the curve in particular.
George, how would you expect the dollar and yields to respond, assuming that we don't get to brinkmanship and that we do get one big beautiful bill passed sometime before the X date in early August?
I would say overall the market is expecting the bill to be passed before the X date. Now, the critical question going forward is who is going to fund those deficits. And we have a pretty strong view that the rest of the world's desire to fund those deficits is going down. Now, of course, the US cannot restructure its debt. That would be extremely damaging. And we saw the discussion around the Mar-a-Lago Accord, how all of that created disruption. But there is one thing that the US can do, and that's reduce its exposure to the rest of the world. So the rest of the world reduces duration, exposure to US duration, so to speak. And that duration, that issuance is absorbed domestically. And I think that precisely goes back to the conversation you were having before around SLR reform. I suspect most of the administration's efforts over the next 2 years will be geared towards increasing absorption of duration risk and long-end treasuries from domestic investors, which have plenty of cash, so that the rest of the world de-risks, effectively moves to shorter duration assets. By extension, that also leads to a weaker dollar, but at least you prevent disorderly outcomes in terms of the treasury market.
And just your view on the shape of the yield curve in the U.S. going forward. Can we expect steeper for longer?
I think in this world where the rest of the global economy is de-risking from U.S. duration because it no longer wants to absorb that risk, you should be expecting structurally steeper curves. And what's interesting is effectively if the Treasury is moving issuance further towards the shorter maturities, that curve should be steepening. And of course, globally now, you have competition for duration. Europe is increasing fiscal spending, both continental Europe and Scandinavia. Canada is, potentially China is. So while the steepening view is consensus, so to speak, I do think there's very strong structural underpinnings behind that shape of the curve.
George, how much do you think that the dollar could potentially decline from here, given that we've already seen a quite considerable move weaker versus all G10 currencies?
So I would say it's a function of how disruptive the Trump administration decides to be. In a more orderly scenario where we're seeing trade deals, of course, the key question beyond trade is how the Powell transition is managed at the Federal Reserve. In an orderly scenario, which is the one we effectively have in our forecasts, we'd be looking for a move in the euro up to around 125, 130. But in a disorderly scenario where Fed independence is being challenged, where the trade disruptions keep going on, the geopolitical and this breakdown of alliances, for example, there's discussion around reviewing the AUKUS deal. If all of that accelerates and the rest of the world disengages from the US, so to speak, I think you could have much more disorderly dollar moves.
George Saravelos of Deutsche Bank, thank you so much. This is one of the risk cases, Julian, that a lot of people have been talking about. Is that something that you also foresee, a potential increasing disorder of the way that the dollar trades?
Well, so look, I think we have to acknowledge that the move away from U.S. assets, and if you think about it, given their incredible outperformance over the last decade, it's as much a risk reallocation as anything else. We don't necessarily think it has to be disorderly. If you look at the last time where it happened over a prolonged period, 2003 to 07, the dollar declined, but yet equity markets were fine. The U.S. underperformed, but that underperformance was still up 100% in a 4-year period.
Which is the reason why I think a lot of people are rejecting this as some sort of secular trend. Annmarie, we are getting some heads from the Ayatollah Khomeini, who is giving a speech right now. What have we learned?
So these headlines, the Ayatollah Ali Khamenei saying U.S. should know Iran is not one to surrender. So this idea of an ultimatum, it doesn't seem like they're prepared to give in, go back to the negotiating table at this moment. Talking about how a U.S. military incursion will result in damage. And then this part, Iranian nation stands firmly in the face of imposed war, but then adds the nation also stands firmly against imposed peace, which basically says to me that Iran is signaling to the United States, if you have an incursion here, even if it's precision strikes, we will have retaliation, especially on U.S. Air Force bases, which we have seen in the past when it comes to Iran, and especially at the U.S. Air Force base in Baghdad.
And there are 40,000 U.S. troops currently in the Middle East. Julian Emanuel of Evercore ISI, thank you so much for being with us this morning. We really appreciate it. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. New details are emerging about last week's Air India crash. The Wall Street Journal reporting that investigators believe an emergency power generator was operating when the plane crashed last week, killing all but one passenger. The report raises questions about whether the plane's engines functioned properly during takeoff. Meanwhile, OpenAI CEO Sam Altman says Meta has been trying to poach some of his staff, offering signing bonuses as high as $100 million. This coming as Meta has been trying to build a new top-tier AI team. It has already invested in Scale AI and is looking to hire engineers from rivals. Altman said, so far, none of our best people have decided to take Meta up on its offer. And shares of Nintendo rallied to a fresh record in Japanese trading after strong sales of the Switch 2. The Kyoto-based game maker sold over 3.5 million units of the highly anticipated console in the 4 days since it was launched. That vastly outstripped sales of the original Switch 8 years ago. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. And I will just say, if someone offers me $100 million, I'm just saying, theoretically, one might take it. Just saying it.
One might want to move offices just for that signing bonus.
I mean, it's just, I know money doesn't talk.
Time to go back to school.
We're
in the wrong profession.
Coming up, we're going to be having a more serious conversation. The IAEA Director General, Rafael Grossi, who will be joining us next. This is Bloomberg Surveillance. Right now, markets resilient even in the face of our top story, which is tensions rising between Israel and Iran. The UN nuclear watchdog saying enrichment facilities in Iran have taken direct military strikes. Joining us now is, I'm so pleased to say, the IAEA Director General, Rafael Grossi. Director General, you have had a very busy couple of weeks. Thank you so much for making time for us. I want to just start with what damage has been done and what remains operational in Iran.
Well, thank you very much. A pleasure to be with you. There has been a number of attacks since the beginning of the operation. First of all, a very important facility in Natanz was badly hit with a full enrichment operating hall being destroyed completely above ground. It means then the electrical substation and power infrastructure in this big facility also being taken out, with a direct impact on a very important underground enrichment facility, which is also there because of the sudden loss of power that caused, of course, immediate damage to these very delicate systems that the ultra centrifuges that produce the enriched uranium are. So this is one thing. Isfahan, another very important nuclear compound, which was repeatedly hit, with a few buildings being affected. The one that has not sustained a similar degree of damage seems to be so far a very important facility, which is also has the most important and sensitive parts situated underground, deep in the mountains, which is the facility at Fordo. Today,
Mr. Grossi, though, you mentioned Isfahan, so if I could just jump in. Is the 409 kilogram stockpile of highly enriched uranium still safely underground in that site?
Well, to say safely, I'm not so sure what could be the case. Let me say one thing, which is very, very important. It is in principle, it is there, it is stored there. As you can imagine, at a time of war, all nuclear sites are closed. So our inspectors, who are still, I must say, in Iran, although they are in a protected place, as you can imagine, but they are not inspecting. No inspection, normal activity can take place. We assume we have not seen anything that would suggest that the stockpile has been moved. But of course, this might need to be reconfirmed as soon as we have access. One has to say that Iran is aware of the fact that this stockpile needs to be there under IAEA constant supervision.
Well, even before hostilities began, Iran had told you that they would implement special measures to protect its enriched uranium stockpile. What specifically are those special measures, and how are they impacting your team that's on the ground?
We don't know. We have been informed, as you rightly say, and I was also told in one of my last personal meetings with Foreign Minister Dr. Abbas Araghchi that in case something happened, Iran would take measures to protect its material, equipment, and so forth. But we haven't been informed of anything in detail. We have reminded, and I have personally reminded in a letter to Foreign Minister Araghchi that there are obligations that need to be observed, and that, of course, we would be available in case they want to share with us, as they should, what they are planning to do, if they are planning to do anything. We don't know what these protective additional measures could be.
Even before the hostilities, we know your inspectors also reported that there was no systemic weapons program. Does that mean that no smoking gun existed to justify what we are seeing right now with preemptive invasion?
Well, I don't know the metric of a smoking gun, how you would define that.
How close are they to making a nuclear weapon, sir?
I have said, let me get to that. I have said that no country in the world is enriching uranium at this level of 60%, which is technically almost equivalent of 90%, which is needed to have a nuclear weapon. At the same time, we are inspectors. We are not political analysts or national political officials. So we have to have concrete proof in order to say that there is an active program to make a nuclear weapon, which we have not seen. That doesn't mean that they are in a territory which is of concern. And this is the reason why there is international concern, why I had a very, I would say, serious report that I presented, as you may know, to the Board of Governors of the IAEA a few days ago. I should also mention that in my conversations with my Iranian counterparts, they have always reminded that there is a fatwa from the leader saying that no nuclear weapon would be compatible with Islam and things like that. But at the same time, I have told them that many high officials have said that Iran has all the pieces of the puzzle. Right. So to speak. So there has been a lot of ambiguity, and this is never good.
Director General, there's a real question about what type of nuclear risk there is. Should there be some sort of explosion at some of these facilities? I know you've been directing a number of studies on this. What have you detected so far, and how concerned are you that a direct strike on Fordo in particular could release nuclear material into the environment?
Well, there could be, of course, a release. We are following as good and as much as we can every military activity and assessing the radiological impact of those. For example, I informed that in Natanz, this facility that sustained the most, I would say, serious damage, there has been some contamination, but it is contained inside the perimeter, if you want, of the facility. So there is no immediate danger for the population. Then, if you move to a higher amount of material, like, for example, these highly enriched uranium and more, because there is not only, let's not forget, there's not only the 60%, there's the 5% stockpile, there's the 20% stockpile, there's a lot of nuclear material around in the country. And of course, a direct impact would have a radiological consequence, which would be commensurate with the attack. So this is why I unfortunately cannot be as precise as I would like to, because it would depend if only a part of it is affected or more. But certainly the possibility of a radiological impact, environmental impact, exists. And as you also know, there are other facilities, including a nuclear power plant in Iran, which of course should never be touched, because this could be another level of concern and environmental damage. So this is what we see at the moment.
Director General, this is one reason why some people have speculated that there has been hesitance by Israelis as well as by the United States of truly dropping some of the bunker bombers and other types of military equipment to try to destroy some of this weaponry. Do you think that this is actually a real risk, the sort of release potentially of radiological material into the environment that you think people are taking seriously? Have you had conversations with the U.S. or Israel?
Well, we have reminded everyone, not that we need to be honest, because I think in the United States, you are the leading country in nuclear science and technology in the world. So I think there is complete awareness, and also in Israel and in Iran and in the region and in Europe. I'm talking to, and I would say in the Gulf states, I'm getting lots of calls from high officials, ministers, prime ministers. They are all very, very concerned about this probability. And I think, of course, I'm a diplomat. I'm not privy to military decision making. But I want to believe, and I think this should be the case, that the potential radiological consequences of any military action is well taken into account. What is important is to return to the diplomatic table as soon as possible, because what is at stake is very serious.
Given the hostilities, can you just walk us through the gap that exists from your inspectors and how potentially what the IAEA does every single day is being degraded?
Well, obviously, I think nothing will be like in the past. We have crossed the line in the sense that there is a war. There is a military conflict, which has been triggered, rightly or wrongly, on the assumption of certain nuclear activities taking place in Iran. And all these facilities, which are or were the facilities that the IAEA inspectors were looking at day by day, some of them have been destroyed, some of them have been affected, and we do not know what the future holds in terms of what may happen over the next few days. So there will, of course, there will be a reshuffle. We will continue inspecting and carrying out our activities. But that will be, and I think we have to be realistic about this, that will be a function of the political and military evolution. Iran has said, and you mentioned this just now in our conversation, Iran has said that they might take additional measures. There are people in Iran saying, for example, which I hope will not be the case, that Iran should leave the Treaty on the Non-Proliferation of Nuclear Weapons and expel the IAEA, as it was the case in North Korea, as you remember, a few years ago. So here, I think, is a big political scenario unfolding, which will hold a lot of events that we will have to take into consideration for international peace and security in the region and in the world, quite obviously.
IAEA Director General Rafael Grossi, thank you so much for spending time with us amid this conflict that I know you are closely following. This is Bloomberg.
What we are really focused on is the path that this conflict takes.
The pictures are worse, and yet the market wants to go up. The market will continue to look through it as long as the U.S. remains out of the conflict.
It's difficult to embrace this view that there's some pervasive risk-off message streaking through markets.
But clarity probably is the scarcest asset that we can find right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. It's Fed Wednesday with the U.S. Central Bank delivering a rate decision and forecast. Annmarie is laughing. We also get jobless claims and housing. The reason why she's laughing is because everyone is on tenterhooks trying to get glean insights about the path of travel in the Middle East where Iran and Israel are at war, and it kind of puts everything else on the back burner.
Absolutely. The Fed is completely on the back burner today, but it will be interesting, of course, what Jay Powell has to say in regards to this additional uncertainty that now the Fed is facing. Fascinating conversation we just had from the Director General of the IAEA, Rafael Grossi, an individual who has been to Tehran, whose inspection teams are still there trying to figure out what is going on amidst these hostilities. So he's reiterated something that we've heard from them: no significant damage at Iran's Fordo site. This is the site that everyone is watching to see whether or not the United States would get involved. Also, there is this political story in the United States about what the DNI director, Tulsi Gabbard, had said a few months ago regarding Iran and whether or not they were on the path to make a nuclear weapon. We asked him about that. Was there a smoking gun? He says that does not mean they are not in the territory of them not being concerned. Basically, where they were in terms of enrichment obviously was a path of concern that the IAEA had, as well as the West.
Yeah, and his commensurate response was very much the diplomacy that he is engaged in on a regular basis. When we look forward, it also raises questions about oil prices and gas prices, which President Trump has welcomed, has argued for, and has really taken the edge off some of the inflation that the Fed has been looking at to see how far it can come down. It raises a question of just how complicated it is for central bankers to really make any decision or any forecast at a time of so much uncertainty and possible disruption to oil supplies.
Lower energy prices was this huge optimistic tone we were seeing in the inflation data, and also coming from the White House, something that should be helping the Fed along. And now there's concern that not just where oil prices are right now, an elevated place because of the geopolitical premium, but how much higher it could go. JP Morgan says you're looking at potentially $130 a barrel if Iran was to take the step and shut the Strait of Hormuz. Now, many analysts would say that just, shoots them in their own foot because they need the Strait of Hormuz to also ship their barrels of oil to China. But at the same time, if they are facing this existential threat, it's been a threat they've waved for years. Would they actually go and do it?
As much as these existential threats are swirling and the what if, markets are resilient in the face of all of it. With futures up, although they've actually inflected down, as we've heard some of those comments over the past couple of minutes, in particular from Ayatollah Khomeini, who came out and said that they would not necessarily look for peace in the face of some of these threats. Basically flat. We are seeing a bit more dollar strength, although still euro stronger versus the dollar at almost 115. Yields lower, and this is something to watch. 4.37% on the 10-year, and what we could see for crude just slightly higher after being lower earlier today. This question about how much we actually do see some sort of resolution versus a doubling down on both sides. Coming up this hour, we've got Chuck Lieberman of Advisors Capital Management as in geopolitical risk looms over markets. Former White House senior advisor to the president, Amos Hochstein, on the escalations in the Middle East, and former St. Louis Fed President Jim Bullard on why the Fed will be on hold until September. We begin this hour with stock steady as traders await clarity from the Fed and the White House. Chuck Lieberman of Advisors Capital Management writing, the war between Israel and Iran dominates the news, but the economic consequences are likely to be minor and, appropriately, market reactions are muted. The recent downdraft is a flight to safety that won't last long. Chuck joins us now. Chuck, what flight to safety? What kind of disruption? I mean, does it sort of surprise you that this market has looked past what in the past at least would have caused a slight notice?
Well, we got the slight notice. The market did react with each development. We do see a market reaction, and typically to the downside. But then the market bounces back. So, yes, the market is very resilient, but yes, it's very well aware of what's going on.
Right now, there's a sense of just how significant the ramifications could be. And Chuck, if there is some sort of escalation and you do see oil prices rise by $10 or even more, would that be a meaningful disruption for markets, or would that just be something that everyone could take in stride given how much oil prices have declined and given how oversupplied certain aspects of the market are?
Well, it very much depends, of course, Lisa, on how long oil prices remain elevated. If they were to spike briefly and then turn right around and go back down, then it would have minimal effect. But I don't see that as likely. I agree with one of the comments that I think Annmarie made, that it would be shooting themselves in the foot if the Iranians close the Straits of Hormuz. So I don't see that happening. Qatar needs the strait to export natural gas. China imports a lot of oil from Iran and from the Middle East. They need that strait open. So I don't think that's likely.
Iran, though, could take another path in the strait, which is also just going after maybe some certain specific tankers or even potentially the Houthis in the Red Sea. Are you concerned about that adding to the price of oil?
I'm concerned because that's the kind of thing that could happen that would push the U.S. over the edge and get us to be to bomb Fordo. The risk is two-sided. On the one hand, Iran could lash out because it's clearly getting pummeled by the Israelis. At the same time, there aren't many things that I see them being able to do. Certainly not that would be disruptive to the global economy. Oil is clearly critical. Other countries do have the capacity to increase supplies. And of course, there are inventories all over the place. So I don't think this thing is going to last a long time. Iran's military position seems to be falling apart. And so I suspect that there's going to be a resolution here before too long.
When you look at what is going on in the world, though, and you're expecting potentially this to not have this great impact, at the same time, though, if this was to become long and protracted, do you think actually the market is well enough supplied?
Well, again, it depends on where. So consider Iran's supplies. Those are going to be cut off. Those are cut off effectively. That's ballpark 1.5 million barrels, but there's a lot of oil in the system on tankers, in storage. If it's protracted, it does become an issue for the world. But if it's protracted, the Saudis and other members of OPEC have an opportunity to increase production. But the disruption would, of course, be even greater if the straits were closed. So you can conjure up a pretty negative scenario. And I think it's possible, but I don't think it's very likely.
Chuck, given all of this, how focused are you on the Fed today?
Minimally, because I think the circumstances are such that the Fed really has little opportunity to justify a rate move in either direction. Certainly not to the downside. Inflation risks are there, both because of oil, but also more importantly because of tariffs. Those are not resolved as of yet. So that's a greater concern. It really hasn't shown up much in the data as of yet, but surely it will. So that encourages the Fed to hold back. And of course, one of the consequences of higher inflation and all of this disruption is consumers and businesses might hold back on spending. And so that can weaken the economy and justify a rate cut. But it's premature. We don't see it in the data as of yet. And so there's no reason for the Fed to rush to make a decision.
And certainly they will not want to say much today, and nobody will be expecting them to do that. Chuck Lieberman of Advisors Capital Management, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Iran's Supreme Leader Ayatollah Ali Khamenei said in a televised address this morning that the U.S. should know Iran is not one to surrender. He warned a U.S. military incursion would result in damage, and Iran will stand firmly in the face of imposed war. Meanwhile, here in the U.S., the newly released Senate tax bill is lacking votes to pass by the July 4th deadline. The current bill's more aggressive Medicaid cuts are one piece driving pushback from some Senate Republicans. Plus, the bill's hardline stance against raising the SALT cap will cause issues with members of the House. And Elon Musk's artificial intelligence startup xAI is said to be burning through $1 billion a month. as the cost of building its advanced AI models races ahead of limited revenues. Sources say Musk's startup is currently trying to cover the gap by raising more than $9 billion in debt and equity. But we're told the company has plans to spend more than half of that in just the next 3 months. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, President Trump weighing his options.
Up to this point, the policy of President Trump, and candidly every president before him since Iran has had a nuclear program, is that Iran will not have a weaponized nuclear program.
Former Deputy Assistant to the President, Amos Hochstein, joining us next. This is Bloomberg Surveillance. Stocks giving up gains from earlier this morning. Futures lower down just by a touch, basically flat, as we do hear from Iran that they are not going to surrender and they are not going to try to make peace under attack. And this is really giving a sense of how far this conflict can potentially go. You could see that haven bid yet again into the 10-year yield. Under surveillance this morning, President Trump weighing his options.
Up to this point, the policy of President Trump, and candidly every president before him since Iran has had a nuclear program, is that Iran will not have a weaponized nuclear program. This world needs less nuclear-armed countries rather than more. And if Iran, Saudi Arabia, the UAE, Turkey have nuclear weapons, that's a level of instability that I don't think we want to undertake.
The latest, President Trump fueling speculation that Washington could join the attack against Iran. Trump met with his national security team yesterday after demanding Iran's unconditional surrender on Truth Social. Bloomberg's Akela Gardner joins us now. Akela, what do we know in terms of what the process is going forward for when President Trump will make his decision and who's going to be involved with it?
Well, the White House has seemed increasingly open to the idea of direct strikes on Iran's nuclear facilities. Vice President Vance made that indication yesterday in a lengthy post on X, saying the president believes Iran cannot have uranium enrichment and saying that could be done the easy way or the other way. President Trump also spoke to Benjamin Netanyahu yesterday. Something he also said is he has not had direct conversations with Iran regarding peace talks. He said if they want to talk to him, they know how to reach him. But potentially a calculus shifter today is a meeting that he has scheduled with Pakistan's military leader today at 1 p.m. And Pakistan is seen as a country that could potentially serve as a mediator between the U.S. and Iran. And President Trump is seen as someone who is easily influenced by the last person he spoke to. But at the end of the day, President Trump has been unequivocal. Iran cannot have a nuclear weapon, and there's increasing concerns about American safety in the regions, especially because there's thousands of troops there, and we have the U.S. closing its embassy in Jerusalem and indicating that Americans should not travel there with a new travel advisory.
Bloomberg's Akela Gardner, thank you so much for that. Right now, we're joined by Amos Hochstein, former Deputy Assistant to President Biden and Senior Advisor for Energy and Investment. Thank you so much for being with us. Always great to speak with you, Amos. I'd love to start with this question that Annmarie was asking the Director General of the IAEA, which is, what do we know in terms of how close Iran has been to creating nuclear weapons, a sort of smoking gun that so many people have been talking about?
Hey, good morning. It's good to be back with you. And look, we really don't know. We have had the Israelis came and said that their breakout time for a nuclear weapon was very short. Of course, the Israelis have said that for a very, very long time, and for many years have been concerned about breakout. So we don't really know why the Israelis, what spooked them that they decided to take that action was required right now. And the administration hasn't really told us that. So I don't want to speculate whether or not there actually was any evidence that it was days away versus the fact that they were months away for a very long time, because we are where we are. They opened this plan of attack against Iran last week, and now the question becomes, how does it end, and where do we go from here once we've started it?
What does a day after, Amos, look like in your mind?
Well, I think it very much depends on this very next step. Right now, we're pretty much in a frozen place. The Israelis have been extraordinarily effective in taking out the Iranian regime's military capabilities, their military leadership, but they're kind of stalled at the moment. Both sides seem stalled at the moment of continuing to take attacks against each other less effective. But the decision is, what do you do about Fordo? And if you've taken this entire operation and Fordo, the nuclear site that is significantly underground, is still intact and there's no resolution to it, you're pretty much where you were before this effort started as far as the risk that Israel had claimed. So the decision now for the administration is, will the United States support Israel's attack and take out Fordo, or will it let it continue to be there and end this? So what is the off-ramp will determine what the day after looks like. And if you take out Fordo, the question is, how do you do it? There's a way to do it by military force that the United States would have to do on its own together with Israel, or is this a way to force the Iranians to come to the table to agree to dismantlement of the facility through diplomatic means? Those will have very different effects, after effects on the day after.
It does feel like President Trump is giving the Iranians an ultimatum: come to the table, or potentially this will be the fate. I want to talk to you about the oil market, because you spent a ton of time looking at where every single barrel is going. Is Iran right now still exporting the more than 1 million barrels a day they do to China?
The exports have been curtailed significantly. And remember, they do two things. One is they sell about 1.8 million barrels a day at the moment before this conflict started to China, mostly to China. But they also sell a lot of products that get not through the official markets, but that eventually make it into South Asia through Pakistan. So all of those seem to be curtailed at the moment. There's not really an ability to produce oil or to export it. So we're going to have to see how that affects the markets as we go forward. But as you know, Saudi Arabia and OPEC had announced increase in production just a couple of months ago. And I think part of it was in anticipation of a decision on Iran going one way or the other, either a deal or war, which is what they had in mind when they made that decision. And that's why you're seeing the market really only increased about 5 or 6% since the beginning of this.
I know many throw cold water on this idea that Iran would actually close the Strait of Hormuz, especially since the fact that this could be shooting themselves in the foot. But even Qatar is asking LNG vessels to wait outside the strait until they're ready to load, because they are concerned about this escalation and the hostilities that are going on. Can you talk about the impact of not just even closing the strait, but potentially the strait not being able to use it as normal?
Yeah, look, I don't pour cold water on it at all. I think that right now where we stand, I don't see the Iranians doing it because they're in a battle against Israel and they do not want to draw the United States in. And that's why they have not taken any strikes against U.S. personnel, U.S. assets, or closing the Strait of Hormuz, and nor have they taken any strikes against their neighbors. But if the United States enter this conflict, the potential risk there is that if Iran feels, if the regime feels that it's in danger of survival and its very existence is threatened, it could take the decision that if we go down, everybody goes down. And then they pose a threat to the United States, to our allies in the region. But also that is when you take these kind of dramatic steps of closing the Strait of Hormuz, or at least attempting to close the Strait of Hormuz. So it is possible. I just don't see that in the current level of escalation that is likely on the table, but that could change very, very quickly.
Amos, how close is the United States to bringing a whole bunch of oil rigs back online that have gone offline in the face of some of the lower oil prices over the past couple of months, in order to offset any disruption to supplies that could arise from a closure of the Strait of Hormuz?
Well, look, first, it's very difficult to bring rigs on very quickly. You got to get the crews back. You got to get it's a lot of work to get it done. You can do it. But if the Strait of Hormuz, and I said this is a very big if, are closed, the volumes that we would bring up in the United States are a drop in the bucket for global supply. So the United States currently producing from I would say over the last 12 months, has been consistently producing about 13.5 million barrels a day. The United States has supplies here at home for its use, but we would see very high prices as the Strait of Hormuz is a choke point of nearly a third of the oil produced in the world or shipped in the world. So it's not about bringing on some rigs. We're going to be, the world will be significantly in a shortage position, which would cause prices to spike. But again, I don't see that is the threat that is imminent at the moment. But I take the threat from Supreme Leader Khamenei today that he would take actions against the United States and the world if we joined this campaign very seriously. But again, we're not there yet. And that's why I think this threat to the oil markets and to the global economy is only if the United States joins the attack and if the Iranian regime decides to expand its retaliation against us.
Former senior advisor to President Biden, Amos Hochstein, thank you so much for spending time with us. And Annmarie, I'm struck by the fact that no matter what happens, it seems like the landscape has been fundamentally changed.
Absolutely. This is a seismic shift potentially for the Middle East. I think the question is how long does it last? And obviously the question on everyone's mind is whether or not the U.S. enters the fray in an offensive way. They are part of this in the sense that they are providing defense to the Israelis, but will they become more offensive? And to Amos's point, if you actually want to take out nuclear abilities when it comes to Iran, you have to go after Fordo, and the only country on the planet that can do that is America.
And right now, people are putting this all together and shrugging their shoulders, watching all closely, but not seeing a huge reaction in markets. We've come off some of the earlier gains that we had been seeing in futures. They're basically flat right now. Oil prices had been negative going down. Right now, they are slightly positive, a bid into the haven asset of treasuries as people look to what could be happening. We do have a Fed meeting today. We also have economic data. It might seem like an afterthought, but a lot of people look to what comes after this in terms of driving the narrative. And the question really is how much the U.S. economy is slowing. Coming up, we're going to be speaking with Jill Carey Hall of Bank of America on the outlook for small caps with the Fed on hold. This is Bloomberg Surveillance. Trying to find some direction as we have a plethora of narratives right now. We're seeing futures little changed as they assess the risk that Ayatollah Khamenei has put out there, saying he is not going to succumb to Israel. And you are seeing him say we will not just simply give up and go for peace in the face of this potential incursion. Right now, we're seeing equities climb just a touch, really led by NASDAQ, 2 hours away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa. We're seeing Circle climb this morning. This company is a stable coin issuer, up 3%. Some legislation passed from the Senate around stable coins, basically saying that issuers of dollar-pegged stable coins need to hold one-for-one treasury, short-term treasury assets. In other words, it's just more legislation that those in the industry hope will make stable coins more mainstream. Also, some sell-side action for you this morning. We are seeing an upgrade to analog devices. The thought there being that analog chip makers are going to have a recovery, and analog devices, the assumption is that's one of the best in class. Those shares up 1%. Finally, wrapping things up this morning with UBS. They have confirmed that they are victims of a cyber attack. Longtemps, the Swiss newspaper, reporting that 130,000 employees have gotten their information stolen and published on the dark web. That includes Sergio Armati's phone number. Let's hope he's changed it by that point. Adding insult to injury, Morgan Stanley also downgrading UBS this morning, saying new requirements for capital put on by the Swiss government is also going to harm their ability to bring in the earnings. Lisa.
I love that, Danny. That is probably the most pernicious aspect of the whole thing is a phone number of the chief executive getting leaked. Thank you so much for that. On our radar this morning, strikes between Israel and Iran reaching a sixth day as Iran's supreme leader warns that the battle begins. The threat coming hours after President Trump called for unconditional surrender and held a call with Israeli Prime Minister Netanyahu. A real question, Annmarie, about just how far the U.S. is willing to go.
That's the question on everyone's mind, especially since the president abruptly left the G7. Why I am sitting with you here today, because he left the G7, went back to Washington, so everyone felt like something was imminent. He met with his national security team. He had a call with Benjamin Netanyahu. And yet, what we see so far from the United States is just movement of military assets in the region, preparations to potentially undertake an attack, but not an attack yet. At the same time, the president, in his social media post, it's very clear he's giving Iran an ultimatum. I think the message from Washington is clear. You have a decision to make. You can make it, or we can make it for you.
And you have to make it with a number of safeguards to give people the sense that this is something that is going to be longer lasting. And certainly we are watching this closely to understand what the disruption could be, not only to oil supplies, but also to people's lives throughout the Middle East. Meanwhile, in Washington, D.C., the Congressional Budget Office now estimating the version of President Trump's tax bill passed by the House would add $2.8 trillion to U.S. deficits over the next decade, with some estimates as high as $3.2 trillion. It would only have a marginal impact on the economy. And this comes, Annmarie, as we see real tension between what the Senate's looking to do and what the House did.
And even inside the Senate itself, can they themselves come to an agreement and get this over the finish line? Will it go through the Byrd rule and be ruled by the parliamentarian that this is all above border, above the fray, if you want to use the reconciliation process? What's interesting in this new estimate is that it's higher than even the previous estimates. The Republicans will push back and say this is not dynamic scoring. It's not fair. But I pulled this out for you because I thought you'd like this, Lisa. The CBO also said higher interest rates from the bill would add $441 billion to deficits over a decade. The higher interest rates are a problem, which is why the SLR story is actually really interesting, because Treasury Secretary Scott Bessent had said to David Weston, we could see this over the summer, and potentially this will help keep Treasury yields lower.
Okay, just to rip up the script to go back to what Tom Keene used to always say, this particular potential rule or regulation that would be dropped would allow the biggest banks to potentially own more treasuries. It doesn't say that they are going to be exempt from this liquidity rule, but there is this sense that there will be a change that will make it easier for them. Will they want to, though? How much will this ultimately lower rates at a time when people are looking at inflation risks, when they're looking at the potential for some sort of extra risk premium to U.S. assets?
It's a great question. Does the rule matter now? Does loosening the rule encourage banks to actually want to boost the holdings when people come on this program every single day and say, actually, the 30-year Treasury is a risk asset? But the Treasury Secretary did say in their estimates, if they would tweak it, it could reduce Treasury yields by 10 basis points. That is why this is important right now when they are trying to get this over the finish line and trying to quell concerns in Washington, also the bond market, that they understand how this could potentially add to the deficit.
Well, I just put into ChatGPT, how can we lower benchmark yields in the U.S. and maybe it can solve the problem for us. Meta is reportedly going all in on efforts to ramp up its AI team. OpenAI CEO Sam Altman saying this, that his employees were offered signing bonuses as high as $100 million to jump ship. Altman went on to say that none of his people decided to take Meta up on its offer, at least none of his best people, which has left us to wonder, why not? Because
what are they offering?
Right, exactly.
$150 million bonus?
He was saying that they like this sort of innovative atmosphere over at OpenAI, but it really highlights how vicious this battle for talent is in the AI race.
Well, I'm just going to say what Sam Altman said. Quote, it is crazy. That is crazy. And has you start thinking that potentially you chose the wrong route when you were in university. Maybe you should have done computer science when it comes to AI. But it just feels almost unthinkable that this would be a signing bonus, but just shows that whoever has the most money right now is going to win in this race.
And Maria, I love that that's your takeaway. You come in and you say, I did it wrong. Well, what was I thinking with this whole journalism gig? Right now, let's turn back to equities. The Russell 2000 is the cheapest it's been on a relative basis compared to the S&P going back to 2008. Investors looking for catalysts to spark a rally in the index despite low valuations. Joining us now, I'm so pleased to say, Jill Carey-Hall of Bank of America Securities. Jill, thank you so much for being here. So how can we get more excited about smaller companies at a time when there's a real question around the U.S. consumer? There's a real question about just how low those rates can go. Mm-hmm. And there's a real question about how much the Fed is going to respond.
Right. Yeah, I think it's still a challenging backdrop for the Russell 2000. I mean, the index is pricing in maybe modestly higher rates on the 10-year yield. But, you know, if we look at the deficit and the reconciliation bill and the fact that this is still an issue that, could cause rates to potentially go higher rather than lower. The Russell 2000 has become more negatively correlated with the 10-year than it's ever been. So, I think lower rates would be a positive for the index. The Fed has been a big driver of the index, and our economists at BofA are not expecting the Fed to cut this year. I think the other issues that have been plaguing the index have been just the fundamental backdrop. We're still in a profits recession. We didn't get out of it in 2Q. Analysts are forecasting a big recovery in the second half, but estimates are still coming down. Guidance wasn't great. Corporates were still sounding negative on this earnings season call. So I think, if we see better signs of the fundamental backdrop of manufacturing recovery, corporate earnings are, tend to be very sensitive to the manufacturing backdrop. We haven't been able to see the ISM sustainably go above 50. Some of those things would be, better confidence instilling.
So for the bulk of the show, we've so far been talking about the Middle East and what happens geopolitically that could potentially disrupt this economy. And we've been asking, who cares about the Federal Reserve? Or people could actually care about the Fed meeting today. And we could hear your voice over there in the hallway. I care. This is actually really important. And I just wonder, from your perspective, if we weren't talking about the geopolitics, how much we would be focused on the fact that the economy has been softening pretty significantly and that economic surprises have been surprising to the downside at a time when inflation, albeit still early days, really hasn't shown signs of being really elevated or sticky.
I think, there are likely to be signs that inflation is still sticky. We didn't see a lot of the tariff impact in May, but there's potential that we see it in subsequent months. And then, just given base effects, we are expecting inflation to remain relatively elevated. I think, the economy, we continue to watch signs in terms of the consumer, the hard versus soft data. I think, the consumer, but also the manufacturing economy, as I mentioned, are going to be key in terms of earnings. And, we'll start a new earnings season in July. But, the Fed has been, one of the biggest drivers of some of the rallies and sell-offs in the small cap index that we've seen. So, I think given the refinancing risk that small caps face over the next several years, this has been something that investors have been watching closely. So, that's not to say that you can't buy small caps in this environment. I think, in fact, that it's a really good backdrop for stock selection rather than buying an index, because there are a lot of cheap stocks. The valuations are good relative to large caps, but you have to be selective, focusing on the ones that are less rate sensitive or in areas that actually benefit when rates do go up, if that's a risk. Small caps that have positive revisions, which is the scarce resource in this environment where estimates are coming down, and higher quality stocks.
We haven't seen the tariff hit yet. Maybe we won't see as big as some people are expecting. But if we were to see that tariff impact, what is it going to mean for small caps versus, say, some of the bigger companies?
Yeah, I think the challenge for small caps is, even though they're less globally oriented, although even that has the gap between small and large caps foreign exposure has narrowed a lot in recent years. They have much thinner margins, so higher input costs are a much bigger earnings hit for these companies. So the potential hit from tariffs, wherever we ultimately land on the rate, we think could be about a 3 times bigger earnings hit to the Russell than to the S&P.
What about the other policy uncertainty? If we don't get this tax bill and the corporate tax rate goes up?
Yeah, I think, one of the omissions from the bill was obviously a lower corporate tax rate. I think last time around when the corporate tax rate dropped, that was a much bigger benefit to small caps than to large caps. This time around when the corporate tax rate was discussed being potentially lowered, it would have been a little bit of a boost, not anything significant. But obviously, if the corporate tax rate were to go back up, that would be a much bigger hit.
Where have you seen actual expansion of profitability? What sectors at a time when we have talked about a general weakening in the manufacturing sector, but we did see a record share of discretionary spending on restaurants, of all things? I know that none of us can cook particularly well, or some of us can, but there is this question of what are we actually seeing in terms of the areas that are outperforming?
Mm-hmm. Yeah, I think, the profits decline has been pretty broad-based. And when you look at revisions, it's, been in a lot of sectors across the board. I think when you look at performance and what parts of small caps have done well, it's been, stocks that have margin strength, which is important given this tariff uncertainty backdrop. backdrop. It's been the ones that have positive revisions rather than negative revisions. So it's been quality. I was at a dinner with some investors last night in the healthcare sector, and that's a sector where no one's going back to really low quality biotech stocks yet. They're still, even in that sector, looking for more revenue generating, higher quality companies. So focusing on quality, focusing on mid caps within the SMID space. We do like mid over small. We think there's better profitability trends there, cleaner balance sheets, less risk from tariffs and uncertainty. So given all of the risks, geopolitics, everything going on, higher volatility tends not to be good for small caps. And the real catalyst for when do we see the biggest rallies in the Russell tend to be those bounce off the bottom phases. And we haven't had an economic recession, nor are we expecting one, but we have had a profits and manufacturing recession. So if we can see signs that those are turning around, then I think that could be a better backdrop for the index overall.
Jill Carey Hall, thank you so much for being with us. It's Jill Carey Hall of Bank of America Securities. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg brief with Yahira Anand. Yahira.
Hi, Lisa. Top U.S. bank regulators plan to reduce a key capital buffer by up to 1.5 percentage points for the biggest lenders. This comes after concerns it constrain their trading in the $29 trillion treasuries market. Sources tell us here at Bloomberg the proposal will look to change the overall ratio rather than exclude specific assets like treasuries, as some observers had predicted. Meanwhile, President Trump has extended for a third time the deadline for Chinese company ByteDance to divest its U.S. TikTok operations. The 90-day extension provides another lifeline for the app, which has been a source of friction between the U.S. and China. It also gives the Trump administration more time to secure a complicated agreement that would require an American buyer and Beijing's sign-off. And the Senate passed stablecoin legislation with a 68-30 vote, setting up regulatory rules for cryptocurrencies pegged to the dollar. The legislation requires dollar-pegged stablecoins to hold dollar-for-dollar reserves in short-term government debt or similar products overseen by state or federal regulators. The House must now decide whether to take up the Senate bill or negotiate a compromise measure. That's your Bloomberg brief. Lisa?
Thank you so much, Yahira. Up next, a wait-and-see Fed.
We are going to get a lot more wait-and-see guidance from Fed Chair Powell unless something radical changes. Not only is nothing happening at this month's meeting, but nothing's going to happen in July either.
Joining us next is former St. Louis Fed President Jim Bullard. At a certain point, why would they say anything, given that nobody seems to have a definitive answer on much of anything? This is Bloomberg Surveillance. Markets are quiet as they reel with geopolitics very much in the forefront, even amid the Fed's two-day meeting that does conclude today. At 2 p.m., we do get a rate decision in Washington, D.C. At 2:30 p.m. in Eastern Time, we are going to get that press conference from Jerome Powell. Right now, markets quiet, up about 0.25% now on the S&P futures, and we could see 10-year yields lower by just about 2 basis points. Under surveillance this morning, a wait-and-see Fed.
Are going to get.
We'll get that in just a minute. Right now, here's the latest. Markets awaiting the Fed rate decision out later today. The consensus widely expecting the Fed to hold rates steady, but update its economic forecast, which might be the most interesting part. Former St. Louis Fed President Jim Bullard joins us now for more. Jim, so glad that you could join us. Thank you. I want to start with, why would they say anything today at all? Can they avoid, I guess is a better question, can they avoid saying anything at a time where there is so much uncertainty?
Yeah, well, the Fed's certainly not taking the headlines today with the war in the Middle East, so that might play to their benefit. I don't think they would have said too much anyway. I do think there is the SEP coming out, and this will be the first SEP post April 2nd, and so I think it will be a more stagflationary SEP. And I think markets are already anticipating that, but there is some room there for surprise, depending on where that goes. And so I think during the chair's press conference, he'll want to be talking about the SEP.
Well, yeah, the idea of whether they do downgrade growth and increase their expectations for inflation at the same time. How do they respond with the dot plot? How do they respond with the reaction function? And that's really the ultimate question. Do they place the emphasis on inflation, or do they place the emphasis on the slowing growth and potential hits to the labor market? Do you have a sense, Jim, of whether this Fed is more focused on inflation than growth, or if their focus is shifting just a little more with some of the weakening data that we've seen over the past couple of weeks?
Well, that's why this will be moderately interesting. I think you've also got comments from many members of the committee, but I think that if it was me, I'd be talking about slower growth due to the trade war, because that's what happened in 2018, 2019. And I'd play down the inflation effects because I didn't really see too much in that earlier trade war. In fact, core PCE inflation actually declined in the first half of 2019. And by the time you got to the summer of 2019, the economy was slower and the Fed lowered the policy rate. So I think the baseline would be here to get to September and make a judgment there about how they want to play this for the rest of 2025.
Well, Jim, given your analysis and given the actual hard data we have seen with inflation coming down in the past 4 prints, why wouldn't the Fed be cutting today? Or do you think they would if they weren't so concerned about the uncertainty from policymakers in Washington?
Yeah, I mean, I think one thing is just to get past this deadline, the 90-day deadline on trade deals and see what comes out of that, whether that would be extended or whether there would just be deals set or preliminary deals set. I think that would provide a lot of information to the committee. Also, the data on the economy has been reasonably good. Looks like second quarter GDP now is, I just checked it, 3.5%. So that'll offset a weak first quarter and keep the first half on average around 2% or a little below 2% growth. So you're okay on that. A lot of the other indicators are pretty good. Core PC inflation or Dallas Fed trim mean about 2.5% on an annual basis. That's still a little bit high. And so I think the committee's probably got about the right stance here, but they can decide to do something a little bit later in the year, or if the data do come in an adverse way, they can push things off to 2026.
There's another point of consternation as well at this meeting, and of course that's the hostilities going on between Israel and Iran and the concern that there's going to be prolonged elevated oil prices. How does the Fed deal with this?
Yeah, oil price shocks are always vexing from the Fed's point of view. I think the response so far has been muted, considering that this is open warfare between Israel and Iran. I think Iran, militarily speaking, doesn't look like they're in a very good position here. So possibly we get some kind of resolution one way or another. And markets are waiting to see where that's going to come out. But it certainly does affect headline inflation. It does affect what people actually pay at the pump and in the U.S. and around the world. And so that's definitely a factor.
Jim, as we look ahead, a lot of people are saying that this is increasingly a lame duck Fed chair, and that after he is gone, there's going to be someone new in his seat who will be a lot more dovish. How realistic do you think that actually is?
Well, one chair at a time, and it's really the committee that makes policy. It's not really any one person. Certainly Chair Powell guides the committee, but it's having been on it, there's many people with their own staffs and their own analysis, and they've got their own ideas about where policy should go. I do think that the committee's smarter than any one person on the committee, and it really pays off to have a lot of different viewpoints as you're trying to make reasoned judgments about where to take monetary policy for the United States.
Jim, do you think that most of the committee members agree with you that they should be taking the slowing growth more into consideration than the inflationary potential shock, given the fact that they haven't really seen it yet? Or do you think that they are focusing on what some people have said is fighting the last war, which is inflation that got maybe a little away from them?
Yeah, it's a little bit. I think about half the committee. It's once burned, twice shy. I think they really don't want to let anything occur that would send inflation expectations meaningfully higher. You do have these survey-based expectations. Those seem to have a big political element to them, and so I think you have to discard them right now. The TIPS market, 5-year TIPS, inflation compensation about 232 today, trading right in that area. So that sounds pretty good for a 5-year outlook on inflation if you think some of that's a little bit of risk premium. So market is pretty confident that the Fed will hit the inflation target over the 5-year horizon, which is really about the best you can do as far as the Fed.
Former St. Louis Fed President Jim Bullard, thank you so much for being with us. And this is for you, Rachel. Boiler up, which I assume is where he is right now. I'm just looking right now at rate expectations. We do see now one full rate cut being baked into Fed funds futures, fewer than two. Actually, even as we look at some potentially weaker data.
Because the uncertainties, they just continue to mount. And every single day, they almost get worse. It was just tariffs. Now it's tariffs plus what happens if there is an oil price shock. The Fed has to deal with a number of issues. And right now, the hard data is okay. And it's good. So why not just say we're going to wait on the sidelines?
And we'll get some more hard data in just about 35 minutes. Coming up, we speak with Gargi Chaudhuri of BlackRock, Blake Gwinn of RBC Capital Markets, Claudia Sahm of New Century Advisors, and Ryan Peterson of Flexport. This is Bloomberg.
The Fed is going to take its cue from the path of trade policy.
Inflation is the element that they're concerned about.
We know that they are baking in some weakening in the labor market.
They're definitely going to be on hold and evaluating.
In the near term, it makes sense for them to be on hold.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. It's Fed Day. Let's just get that out of the way. The Fed is coming out with a rate decision later today. And more importantly, new economic forecasts. Also getting jobless claims in about 30 minutes time. But dominating the news flow, and the reason why Annmarie laughs every time I say it's Fed Day, is that Israel and Iran are in a hot war, the 6th day of it, and it's threatening to disrupt oil supplies, and very much dominating this feeling of nervousness right now in markets.
Obviously, there's more pressing matters than the Fed. But what is happening right now geopolitically and what is happening in the region, these hostilities, the fact that everyone is waiting on bated breath to see whether or not the United States gets involved offensively, is just another risk and uncertainty the Federal Reserve needs to deal with. You have to think today, and I was talking to Andrew Hollenhorst of Citi, the Fed was sitting there, they saw all this hard data come in on inflation concerns, inflation's coming down. Would they not be cutting? But they have tariffs, and now they have an additional risk of what could happen potentially to the price of oil that we've already seen elevated.
Yeah, arguably the Fed could be the most important story, though, for markets. And I think it is important to note that geopolitical risk typically gets priced out of markets pretty quickly. And a lot of people are saying, okay, ultimately, if you do have this weakening trend in growth, we have seen downside surprises more frequently than we have at any time in economic data going back to late last year. If you look at the Bloomberg U.S. Economic Surprise Index, you have to wonder, to your point, would the Fed be cutting? And if they don't, how much of a headwind is that to the performance of risk?
Right. And then potentially, what does this mean for the path forward? Are rates cuts being brought forward? Because maybe July 9th, as Jim Bullard was just telling us, they actually have some clarity when it comes to tariffs. But what if there's another 90-day extension? Then what does the Fed do with that? So many clouds of uncertainty around Jay Powell.
So we're going to be playing a drinking game later on today, or a bingo game if you want, when every time that Jerome Powell says uncertainty,
it's the new transitory.
It's the new transitory. Right now in markets, taking everything in stride after briefly having a hiccup on the heels of some warnings from the head of Iran. We are seeing a little bit of a bounce back, up about 0.2% in the S&P and NASDAQ futures. Russell 2000 trying to claw some gains out Meanwhile, in the bond space, a bid into that haven asset, maybe a haven once again. You could see it across the curve, in particular on the long end. This may be having more to do with some of the regulatory changes in Washington, D.C. 30-year yields, 4.87%. A real question about how much the Fed will give credence to the idea that we could get further rate cuts this year. And then meanwhile, in the oil space, and this is important, earlier we saw declines. Now we're seeing crude gain as we do see some sort of defiant stance from Iran's Khomeini, this idea that they're not going to simply succumb to Israel's threats and to this desire for them to just eliminate the nuclear program. Coming up this hour, Gargi Chaudhuri of BlackRock. As markets await the Fed rate decision, AT&T CFO Pascal Desroches on how tariffs are impacting business and how they're operating in a time of such uncertainty. And Ryan Peterson of Flexport, as the shipping industry confronts geopolitical and tariff uncertainty. We begin this hour with stocks higher ahead of today's Fed rate decision. Gargi Chaudhuri of BlackRock writing this: the Fed will keep rates on hold and highlight elevated uncertainty. No surprise there. All eyes will be on their statement of economic projections. Gargi joins us now for more. Gargi, how focused are you on the Fed? How focused are you on the geopolitics? How do you sort of weigh the two?
Absolutely. Good morning. Great to be here. Usually, the saying goes, the market can only focus on one thing at a time. And we've had many one things this year. Obviously, oil prices, the impact of geopolitics, what that might do to headline inflation, to consumer, that's top of mind. But obviously, this is an SEP Fed meeting. I think that's also going to be important, in particular, whether they're going to hint at 2 more rate cuts or just 1 more. I think that is relevant. And at the same time, how they handled all this additional uncertainty, to your drinking word game, I think all of that is going to weigh on them. So I think both are going to be important, but obviously the market is the most important thing right now for both the humans involved as well as oil prices and broader risk off in the markets, even for a short term, is certainly the geopolitics in the Middle East.
And just to be clear, the drinking game is with water. We all should be hydrated. So clearly that is where we're going with this. Mine. But there is this question going forward about how much this economy needs that kind of support versus has some sort of threat, not necessarily of overheating, but facing a real sticky inflation that could be really punitive. I'm just wondering, from your perspective and the message from markets, aren't equities telling us that actually there is no problem, even though the economic data might suggest otherwise?
So time and again, we've seen that when there is geopolitical uncertainty in the markets, yes, we see that spike in oil prices. Historically, this has been a great time to be diversified into products like gold because that has been an excellent diversifier. But historically, what we've seen is that the 3-month forward or even the 1-month forward on high-quality parts of equity markets, they have looked through geopolitical uncertainty. However, I think as we go into 2 and 2:30 p.m. today, let's take a look back of what we've gotten since the May 6th, May 7th FOMC last meeting. Inflation has been, and there have been no impacts of tariffs yet. Yesterday, I think the most important thing was around the weakness of retail sales and global IP. That is softening, and I think that is important and perhaps had somewhat of an impact on price action in markets yesterday. And I think the Fed recognizes that. And more importantly, at 8:30 today, initial jobless claims and the continuing claims that have ever so slightly gotten worse. I think those are the important things that we should all be looking forward to. But at the same time, like we've seen before, the market does tend to sort of look through near-term shifts in volatility. And I think the macro picture for now is still not too weak. So equities, or especially quality equities and AI equities, are probably going to be okay.
But Gargi, is that a mistake? For all we know, the president right now is still weighing his options. And one of those options is a strike.
One of those options is a strike. The market always responds in probabilities, not binary outcomes. So let's think about the probability of that. Yes, that's the headlines right now with the surrender headlines from yesterday. For the U.S. to get involved, for retaliatory strikes to come through, I think that's going to be a big thing for the markets. Absolutely. And that's, again, why I would suggest that if you're listening to this right now, if you're an investor, having diversifying stuff in your portfolio, having diversifying asset classes like international equities, having some bonds in the front end of the curve, in the belly of the curve, having things like gold and having inflation protection is really important.
How much have you been advocating for more gold in a portfolio since Trump took office?
So, I won't say it's to do with Trump. I think that we were talking about gold, even if you think back to last year, just as another way in which you can diversify against people moving away, other countries moving away from the US dollar. It's certainly a geopolitical risk. And by the way, we've been faced with geopolitical risk much before November 2024. This was something that has the geopolitical fragmentation that we're seeing, wars, India, Pakistan, Israel, Gaza, and now, of course, with Iran. That's been going on for some time. So we've been talking about that, and I think it's a ballast in a portfolio that investors need.
I'm going to put you on the spot, so I
Please
apologize
do.
in
No.
advance. But a lot of people have been talking about stock selection, and they've been talking about the importance of going away from indexes and moving into companies where you're not focusing necessarily on big existential risk, but you're focusing on AI adoption, or you're focusing on the fact that people are eating more breadsticks at this particular company. How much is that challenging some of the ETF landscape and the indexing landscape that got a lot of popularity at a time where there was a much more beta type trend rather than this sort of alpha aspect to the conversations we have today?
Absolutely, not a challenge at all. Actually, when we think about where BlackRock has been able to garner the most amount of flows, it is investors more and more adopting active ETFs. So exactly the trend that you're portraying is playing out in the markets, where active ETFs such as BAI that focuses on AI in an active manner, because obviously you can't just set it and forget about it. Things like BINC, which is flexible fixed income, where you're focusing on harnessing income in the markets. Those have been so popular. That's because investors are recognizing the need to be dynamic as well as quite nimble in this environment. Having said that, for many investors who are just entering the markets, that need to understand the market is theirs to own, perhaps owning just a simple index is a very good first step to be in the markets. And frankly, when we look at the flows, there's a tremendous amount of inflows to products like Bitcoin, for example. IBIT, it's obviously an index product, but something that has garnered huge amount of inflows year till date, and products like the very front end of the fixed income markets with SGov. So there is a place for both, but absolutely no doubt investors are focusing on more and more bespoke ways to access the market with active fixed income and active equity ETFs.
Bitcoin ETF in tandem with the gold ETF. I just wonder, how do you have Bitcoin that's the underlying to an ETF that people, we can get into that. Gargi, Chaudhuri of BlackRock, thank you so much. I mean, it raises this question, though, in terms of how people are seeking some sort of new type of haven at a time where a lot of the narratives have been turned on their heads.
People are getting creative because, as we've been hearing time and time again, people are not going and rushing back into the treasury market the same way they would in a flight for safety that we've seen in the past. This feels like a new paradigm shift in the market. Does it last? I think that's the question.
Yeah, and a lot of people would push back against that, and others would argue, and then we can have this debate, which we'll be having for the next couple of weeks. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. President Trump is weighing his options for potentially getting involved in the Middle East conflict as fighting between Israel and Iran enters its sixth day. Trump met with his national security team for more than an hour yesterday, and after the meeting, he spoke with Israeli Prime Minister Benjamin Netanyahu, according to a White House official. Meanwhile, Treasury Secretary Scott Bessent is likely to meet with officials from China in about 3 weeks to continue trade talks. Bessent telling the New York Post that he agreed on an early framework to restructure trade barriers in the meeting with his Chinese counterparts earlier this month. He said the next meeting aims to accomplish a mutual rebalancing between the two countries. And the Florida Panthers are back-to-back Stanley Cup champions after beating the Edmonton Oilers in 6 games. In the rematch of last year's series, Florida outscored Edmonton 10-3 over the last 2 games to cap off a remarkable playoff run. Panthers forward Sam Bennett was named the Conn Smythe Trophy winner. He led the league with 15 goals in the playoffs. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, we're going to have a conversation with AT&T CFO and Dallas Fed board member Pascal Desroches. We'll also have the morning calls. That's all coming up next. This is Bloomberg Surveillance. Markets doing what they tend to do, which is shrug off some of the existential risk that we talk about every single day. Right now, after a brief hiccup, we do see those gains in futures across the board, up about 1 to 2 tenths of a percent for both the Russell, the S&P, as well as NASDAQ futures. Time now for your morning calls. First up, Morgan Stanley downgrading UBS to underweight, saying Switzerland's new capital proposals will constrain UBS, adding that it will likely continue underperforming competitors. Next up, Guggenheim lifting its price target on Oracle to a street high of $250, continuing to see the stock as the best idea amid the technological innovation that we talk about every day. And finally, Argus downgrading Norwegian Cruise Line to hold, noting its vulnerability to weakening consumer spending and slower economic conditions. Those shares lower by about 1%. Economic uncertainty having an effect on many stocks and sector. In its first quarter earnings report for AT&T, saying, quote, tariffs could potentially increase the cost of smartphones and other devices, as well as the cost of network and technical equipment. We believe we can manage the anticipated higher costs. Joining us now, I'm so pleased to say, is AT&T CFO and Dallas Fed board member Pascal Desroches. Pascal, great to see you. Thank you for being with us. I want to start with this question.
Thank you for having me on, Lisa.
I want to start with this question. We look around and we talk about this incredible uncertainty in the environment. How do you keep spending? How do you keep investing in capital expenditures with any certainty at a time when potentially the environment is changing pretty substantially?
Look, we start from the standpoint that we have a critical goods and service that is really in demand by U.S. customers. And so we know that the demand will be there pretty much irrespective of the economic environment. And for us, we have a pretty manageable tariff outlook. The main place it's going to hit us is in hardware equipment in our networks. And we believe we'll be able to manage through it. And that's why we had enough confidence to reaffirm our full year guidance. And so our belief is really underpinned by the demand for our services, both wireless and broadband.
There is a question right now about how much resilience there is in the economy. And even though ultimately we all need to be connected so that we can look at our online profiles and social media, et cetera, there is a sense that people will cut back on certain spending should there be some sort of downturn in a significant way. And I know you do sit on the Dallas Fed. How much are you seeing evidence of that versus an ongoing willingness to spend in a whole host of capacities at a time where, yes, people are interested in the technological advancement, but also they still have jobs and they're still out there living their lives?
You know, ironically, here's what we're seeing vis-a-vis the U.S. customer. We're seeing probably a little bit better demand than we expected at this point in the year, in particular for wireless services. And we believe that is a pull forward of demand from the second half in anticipation of tariffs. Many customers want new devices, and they're out shopping in advance of the tariffs becoming effective. More broadly, we have a broad base of customers across the U.S. And so far, things like credit metrics, collections, all of it seems to be trending positive and consistent with our expectations.
Meanwhile, you did see you make a pretty big acquisition at a time when we haven't really seen the huge M&A wave that a lot of people were expecting. You agreed to acquire Lumen's mass markets fiber business, and it incredibly expands your footprint in an area that you think is really the next thing. Why do you have that conviction now to make such a large acquisition at a time when potentially people have been talking about uncertainty and the fact that a lot of deals have not been able to make it through the finish line?
You know, this is a business that we know how to run very well. We've proven it the last 5 years. We've significantly expanded our footprint in fiber, and we've done a great job of penetrating it. With the Lumen acquisition, we get access to a really attractive footprint with really nice demographic qualities. And our belief is we can go and we can invest in that network, expand the network, creating new jobs in the U.S., good middle-class jobs, and at the same time delivering a really strong return for our shareholders.
How much, Pascal, do you feel like you're immune to some of what we're seeing in terms of the overall economy, given the fact that increasingly everything relies on the connectivity? I mean, it's sort of this question of what's independent of the overall economic cycle and what isn't. How independent have you become?
Well, look, I think an economic downturn will impact everyone, including AT&T. With that said, I do think we will be more resilient in that environment just because of the criticality of our goods and service. But we would anticipate that there would be less demand if the economy were to turn down. But so far, we haven't seen it. And right now, given how critical our services are, I think we would probably see it a little bit later than others in the economic cycle.
There's also the benefit of the artificial intelligence adoption, and a lot of people have been going into companies like yours to bet that there is going to be this expansion and that ultimately it's going to be all the more important to have a fast connection to the internet, which is one reason why fiber is going to become all the more important. How closely have you been talking with some of the big tech providers and just in general? How much have you benefited from what we have seen with the AI developments?
Oh, look, it is going to be a growth opportunity for us, and it's part of why we have such conviction that we must invest now for the future demand that will exist for broadband connectivity. And in particular, whether you think about the hyperscalers, data centers, they are powered by our connectivity. And so this is why it's so critically important we invest, because there are long lead times to delivering the capacity that is needed.
Pascal Desroches, thank you so much for joining us. Always wonderful to speak with you. And next Wednesday at 9:30 p.m. Eastern, you can watch our extended interview with the AT&T CFO on Bloomberg Chief Future Officer. We are just about 8 minutes away from breaking jobless claims and housing data. Bloomberg's Michael McKee joins us now. Mike, I would love to get your sense on what we're expecting on a very strange Wednesday jobless claims release.
Yeah, we do have the Juneteenth holiday yesterday, to tomorrow, rather, and that's why they've moved back jobless claims to today. Jobless claims will be the focus rather than the housing numbers. We know the housing situation is not good now because of where Fed interest rates are, but interest rates might change if jobless claims change significantly, if they should rise. The forecast, according to economists surveyed by Bloomberg, is that there's going to be a slight decline, not just in the weekly claims, but in the continuing claims number. Last week, we had a big jump in continuing claims, and a lot of economists and analysts took that to mean a weakening labor market. But at this point, there's no other confirmation that would support that. So everybody's going to be watching closely today.
And when you fast forward that to what this looks like for 2 p.m. and 2:30 p.m. later today, when we'll be talking about what the Fed is doing, and you'll be asking questions to Fed Chair Jay Powell. How much are they watching some of this high-frequency data versus looking past it, looking at longer-term trends and looking at their forecast that is likely to be more stagflationary, a downgrade in growth and an upgrade in inflation expectations?
Well, they're going to be looking at the high-frequency data for any clues to what might happen, but they do want to see longer-term numbers that suggest it's a continuing trend rather than just a one-off kind of weekly report. Now, the Fed says it works on the medium term. So they're going to be trying to look at all of this data and what comes out of the White House and what comes down from Capitol Hill and figure out what it might mean for a year or two from now. Because, of course, even if they change rates today, it'll take a while for that to get into the economy. So the Fed isn't going to be immediately reacting to numbers, but they are going to be taking them in and trying to plug them into some long-term model of what's going to happen.
Mike McKee, thank you so much. And please stay close because we will be breaking down that data when we get it in about 6 minutes time. Meanwhile, we are seeing markets that are actually shrugging off a lot of what we saw earlier today in terms of the back and forth between Iran and some of the threats from Israel as well as the United States. And it raises a question about whether the Fed will still emphasize inflation, whether they're going to emphasize a threat to growth, or whether they'll just simply say, look, we have to wait and see. There's a lot of uncertainty during and then honestly, we'll make a decision later in this year.
I think you put it best earlier when all of this just gives them a pass. It gives them a free pass basically a hallway pass to say, how are we supposed to make a decision in this type of environment? But continuing claims is interesting. And Neil Dutta was on the program on Jobs Day, and he was talking about continuing claims keep rising to these fresh highs. He talked about P&G, Paramount, Microsoft, Disney. You have seen some layoffs. Is this showing that we are seeing a bit of a weakening in the labor market, even though the hard data has held up so far?
Yeah, they have a hall pass when it comes to giving any certainty. They don't have a hall pass when it comes to explaining what their statement of economic projections might show, which is ultimately a stagflationary type of backdrop. And then their dot plot suggesting how they would respond to that. That will be really the key question. What is your way of responding to stagflation? Is it emphasizing the inflation aspect, or is it emphasizing the weakening economy? Coming up, breaking that economic data down after ahead of today's Fed rate decision, Blake Gwinn of RBC and Claudia Sahm of New Century Advisors here to react. This is Bloomberg Surveillance. About 25 seconds away from that breaking jobless claims data in markets, you could see a little bit of a lift to futures building on yesterday's gains. What we are seeing right now is up about 0.1%, and you see in NASDAQ futures up 0.2%. In the bond space, a bid into bonds pretty much across the board, more so on the long end, though. 30-year yields 4.86%. With those jobless claims figures, let's head over to our own Michael McKee, Bloomberg economics and policy correspondent. Mike, what do you see?
Well, don't see anything yet. The numbers haven't quite dropped out of the computer at the Department of Labor, but I'll give you the housing starts numbers. Starts down 9.8%. Not a surprise, because we've seen people backing off from buying homes, and the building permits number down 2%. Okay, here's jobless claims. 245,000 is the number from last week. That's down from an upwardly revised 250,000. So we're staying in the same range, but we haven't moved a whole lot, and we've come down a little bit. We do come down a little bit in continuing claims, 1,945,000, down from a revised 1,951,000. One thing you want to do in the claims numbers these days is to look at the unadjusted numbers, and the unadjusted numbers suggest that what we're seeing is some rising numbers, but they're being seasonally pushed down because it's that time of the year when we have some confusion about when schools end and stuff like that. So not bad numbers today. Like I said before the break, it's not going to affect the Fed's decision today, and it just reinforces the idea that anybody who is waiting to make a decision based on the data are still waiting.
Michael McKee, stay close as we wait and parse through some of this data. If you look at the market reaction, it is somewhat muted, but on the margins, more of a bid into treasuries. Treasury yields lower across the board, particularly on the front end, about 2 basis point decline, 3.94%. If you bleed it through what's going on in foreign exchange, a little bit of a pop on the intraday for the euro versus the dollar, currently at 115. And meanwhile, if you take a look elsewhere, you could see just the risk appetite, which has been on and off after yesterday's losses. You are still seeing equity futures hold on to some of those gains. Joining us now is Blake Gwinn of RBC Capital. Blake, great to see you. Thank you so much for being here. I want to just go to your reaction, how important these jobless claims are, given the fact that they have been inflecting upwards and yet not necessarily screaming some sort of red flag that the economy is falling off a cliff.
No, that's exactly it. I think a lot of the stuff we've seen I would consider very low-grade pain. The way I've been thinking about it in terms of this FOMC, there's really been nothing severe enough to really pull them out of this wait-and-see mode. There's some concerning signs potentially in claims. You've seen the permanent layoffs in the unemployment report starting to tick up a little bit. They kind of stabilized this last month. Things like the labor market differential that a lot of people look at. There's clearly signs of softening, but everything's been very low grade. So I just don't think there's been anything that really worries the Fed to the point where they come out of this wait-and-see mode.
But we have seen inflation going down. Is that not enough for the Fed to say we can start cutting?
It's kind of odd because I think, when we think about these Fed meetings, particularly the SEP ones, you're kind of marking Powell's comments back to May, but you're marking the dots back to March. And if you think about the net of what we've had since March, we did have Liberation Day. So, we do have probably a lot of the FOMC participants baking in some more extreme kind of tariff scenarios, perhaps higher inflation on the back of that. So you're netting that against the fact that we did have the softer inflation data in May, so the realized looks a little bit lower. And also we've had rollbacks, we've had the 90-day pause. Now we have this court case that's creating a lot of uncertainty around tariffs are going to go. So where it gets for me is that it's kind of done a round trip. I think you net all those things out, and I don't see a lot of reason for FOMC participants to really be moving their forecast that much.
So how long do you think they have to, or they're able to stay on pause?
So we have our first cut in September right now. I think you still get 3 rounds of top-tier data by then. If we continue to see these signs of softening, even if it doesn't accelerate to a large degree, I think when you get 3 months of softening, 3 more months of softening, then you start to get to a point where the accumulated impacts, hopefully you have a little bit more, certainty around where the actual tariff scenario is going. That's where I think they probably feel a little bit more comfort in starting that cutting cycle again. I think what we're seeing is not really emergency cuts. It's not like we're heading into a recession and they need to slash rates, because they're behind the curve or something like that. It's really more kind of restarting precautionary cuts in the way that they were during this last cutting cycle. And we just need to see that the inflation is not broadening out. It's not, we're not seeing inflation expectations rise, all those kind of spillover effects the Fed's worried about.
Well, this really raises the question, when will they actually get a sense of whether inflation will tick up as a result of not only tariffs, but also what's going on in the Middle East and potential shocks to the oil picture?
Well, aside from the Middle East, this is one of the things that actually kind of worries me about my forecast. And if I think about the risk to that September cut call, I think there's a likelihood that we may have to push that back on the fact that they just don't get certainty. This 90-day pause, if we get another rollback, if the courts flip off the tariff switch for a while because they say, you have to take them off and the administration has to find new ways to put tariffs in place. Well, what if we see another wave of front-running activity? That just means 2-3 more months of data that we can't really take any sign from. So it just increases the amount of noise or the duration of the noise that we're seeing in the data, and I think could keep the Fed in that wait-and-see mode for longer than expected. And Middle East is just one more factor there.
The one caveat to all of this is that this is a Fed chair who only has a number of months left before the beginning of next year. And there is speculation, and you're starting to see this affect pricing in markets, that whoever comes in after him is going to be a lot more dovish, a lot more inclined to cut. How much do you see the specter of that hanging over this Fed meeting? Because they are running out of time to really take the helm here.
Yeah, I really try to give the Fed the benefit of the doubt. I spent a decent amount of time of my career at the Fed, so I am somewhat of a Fed apologist, I guess you could say. But, I really do think they can separate themselves from these issues, and I do really think, when you're actually in the room for a lot of these discussions, I think, politics and a lot of these things show up a lot less than people on the outside think they do. People can kind of sit down and do their day job without thinking or being impacted by these politics. So I really think they're going to look at the data. As long as there's nothing pushing them one way or the other, they're going to stay in this wait-and-see mode.
Blake Gwinn of RBC, thank you so much for being with us. Let's do it again soon. It was really fun to speak with you. Right now, Michael McKee, he's had a couple of minutes to look through the data. Mike, what stands out to you?
Well, we had about 10,000 fewer jobless claims filed on an unadjusted basis last week, and the seasonal adjustment factors expected only 5,000, so it's propped up by a little bit. But it does suggest that we are not seeing cracks in the labor market like a lot of people were thinking at this point, at least not immediately showing up in the jobless claims. We have, and I remember Annmarie talking just before the data came out about companies that have announced layoffs. Companies are always laying off people. We have labor flows in and out of the labor force of millions each month. And so it does look like to the Fed at this point that the labor market is holding back, and that just reinforces their feeling that they are okay to sit still and wait and get more clarity on what the administration and Congress is going to do about fiscal policy.
Michael McKee, thank you so much. We'll be catching up with you throughout the day. Joining us now is Claudia Sahm of New Century Advisors. Claudia, great to see you. Thank you so much for being with us. I want to start with this idea that the wait-and-see Fed doesn't have to tell us anything. A lot of people would argue and push back and say, actually, they have to give us a sense of what their scenario analysis looks like at a time where potentially that it could increase their chance of stagflation. What's your sense of what their scenario analysis looks like? What's their response mechanism to that?
Right. I think that'll be a really important part of the press conference today, is to have Powell talk through the risks, the scenarios that the Fed is considering. Unfortunately, their tools like the Summary of Economic Projections, the way it's put together right now, doesn't do a great job of getting, scenarios across. But it is so clear that the Fed is in risk management mode. Right. This is about where inflation could go, how it could persist. And, this is kind of an insurance pause. Right. They want to avoid those risk outcomes. And so then it is a big part of explaining why is it you're on hold? Inflation's coming down. Why aren't you cutting now? So I think they really do need to kind of spell that out and give us a sense of what they're looking for in the data as it's coming in.
What potential damage could they do if they are too late and they should be cutting because inflation's coming down?
Well, it's unnecessary weakness on the economy. I mean, if you look at interest rate sensitive sectors like the housing market, the higher rates, they are having an effect, right? They're having an effect on people who are out there trying to buy homes, builders who are trying to, construct new housing. So, if that is a pain. It may be necessary to keep inflation under control, to keep inflation expectations under control, but there is a cost. Right. And I think the Fed is balancing that well, but it is something that should be communicated, because otherwise, just if you look at the data on hand and you think of the data driven Fed, it's like, well, why aren't you starting to cut or even talking about cutting? Like, they're really not just going to pause today. They're going to push that pause pretty hard through probably much of the rest of this year.
It sounds like you think Chair Powell is going to be hawkish today. We just got a note from Andrew Hollenhorst of Citi, and he said there's 3 reasons for Powell to be dovish. 1, 3 months of softer core inflation. 2, rising jobless claims, continuing jobless claims, and softer housing data. Do you think his rhetoric is going to lean hawkish when a lot of people think he should actually come out and sound a bit dovish?
Yeah, I mean, I think a lot of it comes down to how, to me, one big question to listen to Powell today is to explain, that inflation data in the last 4 months, that's been unexpectedly soft. What's that about? Right? Because if it comes, a hawkish tone to me would be saying, oh, well, the tariff inflation, it's still coming. It's timing. We just need to wait. It's coming. But, you can look in that data and see some nuance, not just from what you think are tariff effects, but just inflation in general, where it's like, man, the demand's a little softer. Maybe this isn't pushing through. Like, anything that he would say today that would kind of soften or push against all of these upside risks to inflation, to me, would, I think, be pretty balanced. But we'll just have to see where he says. And one difficult thing today with listening to Powell is understanding that, he is speaking for the FOMC. That's what he does as Fed chair. He has his interpretation of it as well. And he probably will be in something of a live debate with the dot plot and the summary projection. So it's kind of tough to parse it on days where we get like these forecasts in addition to him speaking.
I love that. A live debate with him basically arguing the side of everyone on the committee and trying to sort of come out somewhere in the middle. I'm struck by what some people keep on saying, which is that a number of members of this committee are fighting the last war. They are so scarred from the use of transitory and failing to curtail inflation a couple of years ago that they are more willing to look through any weakness in the labor market in order to prioritize inflation. Do you expect that to be the same today, which is the reason why people are expecting more of a hawkish tone?
I think we'll continue to see the focus of the FOMC on the inflation risks, on inflation going higher. Again, the claims data today didn't, reinforce any kind of an emergency. And we are at 4.2% unemployment, right? Like, we are in a full employment economy. So we're starting from a good place. Inflation is still somewhat elevated. And just everything we've got in terms of the data. And then, like you said, kind of fighting the last war, the inflation risks just loom really large. But that's where just seeing how they're interpreting the data, how they're questioning their own assumptions about, inflation could really get out of hand. I think that's the piece, that'll be really important to understand if they're focused on the current threats to the economy as opposed to the threats we had 4 years ago.
Claudia, Sahm of New Century Advisors, thank you so much for being with us. Really appreciate your insights. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. New details are emerging about last week's Air India crash. The Wall Street Journal reporting that investigators believe an emergency power generator was operating when the plane crashed last week, killing all but one passenger. The report raises questions about whether the plane's engines functioned properly during takeoff. Meanwhile, Meta is reportedly going all in on efforts to ramp up its AI team. OpenAI CEO Sam Altman saying his employees were offered signing bonuses as high as $100 million to jump ship. Altman went on to say none of OpenAI's best people have decided to take Meta up on its offer. And U.S. dietary guidelines are set to drop the long-held recommendation that adults should limit their alcohol consumption to 1 to 2 drinks per day. That's according to Reuters, which also reports that the new guidelines are set to move away from suggesting consumers limit alcohol to a specific number of daily servings. Reuters says the guidelines are still subject to change. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I can't keep up with all of the changes to the drinking guidelines. Wine was good for you, now it's terrible for you. What is this?
I think it's everything in moderation. What I want to know about, because I've been starting to like mocktails, because especially on these hours, Trump world, you can't be drinking. Why are they the same price as alcoholic beverages? Why is a mocktail $15-18? That's my question.
Well, the deep investigation for Annmarie coming up. Meanwhile, up next, setting you up for the day ahead, plus Ryan Peterson of Flexport as the shipping industry confronts geopolitical and tariff uncertainty. This is Bloomberg Surveillance. Well, we got the economic data, we have the geopolitical turmoil, and markets basically doing the same thing, holding on to some gains after getting the jobless claims, although fading just a touch, up about 0.1%. Pretty much across the board. Russell 2000 still coming under pressure, a bid into bonds, as people do expect the Federal Reserve maybe to recognize the softening trend that we have seen, which has continued, although moving back from some of the earlier gains that we saw earlier today. Counting down to the opening bell, here is the trading diary for the rest of the week. And for next, at 2 p.m., a Fed rate decision, and 30 minutes later, a Chair Powell news conference. On Thursday, tomorrow, U.S. markets closed for the Juneteenth holiday, and we'll get a rate decision from the Bank of England. On Monday, June PMIs, Tuesday, consumer confidence, plus the NATO summit kicks off, so we can expect more discussions around Iran and Israel, as well as potentially Ukraine and Russia. Turning now back to our top story, Israel and Iran entering a 6th day of conflict as White House weighs direct involvement. The shipping industry confronting both geopolitical and tariff uncertainty, raising insurance costs and shipping costs. Joining us now for more is Flexport CEO Ryan Peterson, who I'm sure has been one of the busiest people out there. Ryan, can you give us a sense of the latest disruption in the Middle East and what this has done for just how much it costs to let alone ship something, but insure a ship that is traveling from one side of the earth to the next?
Yeah, great. Thanks for having me on. Well, it's thus far, it's a little early to say. I mean, the biggest thing that's happened so far is cancellations. We've had over 3,000 flights canceled. I mean, most of us think about passenger flights, but of course, 50% of the world's cargo flies in the belly of these passenger flights. So that's a huge disruption in the cargo industry. It's a little too early to say on the fuel prices. But if the Strait of Hormuz was to close, you'd have a massive impact both on fuel price and Jebel Ali, that's the port in Dubai, is the 10th largest container port in the world. So that being cut off from the global ocean would just be a massive, massive impact.
What happens in terms of where these companies are rerouting, though?
Well, ultimately, it's going to, it's not nearly as disruptive as when the Russia-Ukraine war happened and planes couldn't fly over Russia. That's a much bigger problem. They'll just have to go south, further south around, south of the Red Sea and back up. So it's not the biggest disruption in the world from an air cargo perspective. Ocean freight's a different story. I mean, Jebel Ali is just a massive port. If that Strait of Hormuz closes, it's 28% of global oil. And like I said, the 10th largest container port in the world. So that would just be a huge impact.
Do you already see these companies taking this precaution now, even though there hasn't been an actual disruption?
I mean, companies that are shipping to that region are already disrupted in terms of, worrying about the health and safety of their employees, their customers. If you're shipping to Israel, I mean, all flights to Israel are canceled right now, Jordan as well. So certainly it's a localized impact, but on a global scale, it hasn't yet spread to hit the wider global logistics market.
Ryan, this raises a question, given the fact that we've seen a lot of companies feel a lot better about the economic environment after some of the pause in terms of the trade negotiations and the potential tariffs that could be put on, this feeling that they could restart their shipping cargo and get back to business. How much is there actually a back to normalcy in the shipping market versus some sort of increased cost, increased caution, increased cancellations that's been sort of a permanent state of business?
Yeah, I mean, actually right now things are somewhat normal in global shipping. Like the China to US trade lane was hugely impacted, obviously, by the 145% tariff. And then things roared back after it was paused. The interesting thing actually is maybe it's too normal because July the 8th is right around the corner, and that's when the reciprocal tariffs on rest of the world, we have a 90-day pause. That ends on July 8th. So that'll be here before we know it. And then it's in the middle of August when the Chinese tariffs roll off, because again, it was a 90-day pause. So on some level, there's a lot of people trying to pull cargo forward, get it into the country before those tariffs go back, if they do. And then the big question right now is, does this Iran-Israel situation sort of distract the administration? I don't think tariffs are at the top of their list anymore.
How are companies handling the fact that we've had disruption after disruption to shipping and trade over the past couple of years? Since the pandemic, it feels like this is constantly in focus. You've become incredibly popular. I'm sure people call you all the time to try to understand how they can manage through this. What's your sense of how different it is now and how well companies are adapting?
It's, there was a lot of kind of paralysis that set in. I mean, people would like to have some clarity of where this world's going over the next 3 to 4 years, or I mean, obviously longer than that if they could get it, but 3 years would be great. They don't know where tariffs are going to land. It's the way that the administration is rolled out, where every few weeks something changes, makes it really hard for anybody to plan anything. So companies they're ready to say, hey, we'll put our supply chain in a different country. But if you don't know what the tariffs are going to be on any given country, no one can do anything. So there's a bit of a paralysis. And meanwhile, trying to react as quickly as they can. So when they reopened or relaxed the tariffs on China, lowered them back to 30%, we just saw this huge surge of bookings, everyone trying to move ocean freight in as fast as they can while the rate's at that level. And I think we're going to see a lot more action July 8th if the reciprocal tariffs expire. So by default, they go back to the level they were at when they were announced on April 2nd, which, we all remember created massive panic in the business world. So I think people are just trying to be as adaptive as they can and make decisions day by day rather than what they'd like to do is long-term planning.
Ryan, what do you think is harder to navigate, this policy uncertainty we're dealing with now or where we were in the depths of the pandemic?
I mean, the pandemic was just really unprecedented for folks, as there was just an element of personal safety and fear that would not, right now people are worried about macroeconomy and recession, but not their health and well-being so much. So that was probably a little crazier. And then from a supply chain perspective, even after the initial shock of COVID wore off, it lasted for a couple of years where, there's this congestion at the ports. But that was all made up for. It was hard. It was very expensive to ship things. The transit times were really, really slow, like 120 days for a container to go from China to the US when it only takes 2 weeks to cross the ocean. So that was all really tough, but it was made up for by the fact there was this huge surge of consumer demand. People had money in their pocket. There was a lot of stimulus, and cargo volumes were up 20%. So demand for the goods were up really high. If your business is doing well, everything's good. Whereas right now, from a macro standpoint, it feels worse for these companies because they're not seeing an increase in demand. They're just seeing an increase in costs.
Ryan Peterson of Flexport, thank you so much for the insight as we try to figure out how to understand the changes in trade, which have been really fast and furious over the past number of years. Honestly, I mean, this to me has been one of these stories.
And Ryan's talking about people want certainty for the next 3 or 4 years. I think people want certainty for the next 3 or 4 months. We still don't know where the trade levels are going to level off. As he says, right around the corner, we have July 8th.
How about certainty for the next 3 or 4 hours? Coming up at 1:30 p.m. Eastern, a Bloomberg Surveillance special. The Fed decides. Will be joined by Bob Michael of J.P. Morgan, Kathy Jones of Charles Schwab, Rich Clarida of PIMCO, and Jeff Rosenberg of BlackRock. It'll be myself and Tom Keene. Jonathan Ferro is off for the week, so he will be missing out on the Fed special, but we will not, and we will be parsing through the statement of economic projections, just whether they will signal a dovishness or a hawkishness in response to the lack of certainty that we have around us. This was Bloomberg Surveillance.